Good evening, everyone. Would like to welcome you to the August 2023 IBD meetup from Charlotte, North Carolina. We would like to take this opportunity to welcome you, especially if you're a new member. We'll tell you a little bit about the program, and we hope that you derive some interesting tidbits to help you personally navigate through the current market environment. My name is Roy Maddox. I'm the host of the IBD Meetup group, along with Wesley Maddox, who's my son and co-portfolio manager of our investment firm here in Charlotte, North Carolina. We've been hosting the program for about 6 or 7 years, and we're delighted to have about 2,200 members now. We're one of the largest IBD meetups in the country, and in fact, we were invited to speak at the second annual national meetup, which is on August 19th, I believe. So I hope that you can make that presentation along with 6 other meetup presidents across the nation. Let's tell you a little bit about how the program is going to transpire tonight. We will, after this introduction, we'll go through a slide deck and we'll talk about technical factors, fundamental factors, and some macro concepts that are impacting the market currently. Then the second half, we'll take a break for about 5 or 10 minutes. In the second half of the program, I will specifically speak about individual stocks. Typically in a session like this, we might cover 100 stocks in the second half of the program. So that's really what many of the members really enjoy, because we provide many times profit opportunities and great trades and great setups, not just that are presented by Wes and myself, but by the members of the group that participate. We focus on technical factors, fundamental analysis, and many concepts that are featured in the book, How to Make Money in Stocks by William O'Neill. I was fortunate enough to meet William O'Neill and David Ryan in 1988 at a seminar, and that really changed my life. Over the last 35 years, I've been practicing these tactics and techniques exclusively for over 3.5 decades. And in fact, we'll have members on this call tonight that are really old timers, older than myself. So I'm looking forward to those guys interjecting their feelings and their beliefs and their opinions about the market currently, because experience is invaluable when it comes to the stock market. We'd like you to also be aware that the stocks that we talk about tonight are not investment recommendations. This webinar is designed for educational purposes only. So we're not pitching any particular stocks, and we're just going to look at what we think are some of the leading stocks in the market today. So we encourage members to participate, and we always find that to be very enjoyable. Take just a moment and read our disclaimer. Basically, it says that everything that we talk about tonight is not to be considered investment advice. Please consult your own personal financial advisor to get your personal financial advice and to get additional opinions on the market and on stocks. This is a nice acronym for really the process that William O'Neill has espoused for throughout his whole career. As many of you are aware, we just happened to lose Bill O'Neill a couple of months ago, and I think he was in his 90s at that particular time, and he's really impacted, really thousands of investors across the country. We hated to see him leave and depart, but he will always live on, because his concepts will all live on. These concepts, the CAN-SLIM process, it's featured in the book, How to Make Money in Stocks. We're not going to go over each individual characteristic, but you can find them in the book, and we urge you to get the book and study the book. And with that, we're going to talk about technical analysis, fundamental analysis, and macro analysis. And I'm going to turn the slide deck over to Wesley right now. And then the second half of the program, we'll go through tons and tons and tons of stocks. I would like to tell you, give you some basic thoughts of the market. The market is currently in an uptrend under pressure. So the market's in an uptrend. The new high, new low list is a little bit anemic. It's going on the wrong side of the market right now. Many of the stocks that have been leaders in the market up to now they're having enormous sell-offs based on their earnings that are being reported. We've got some headwinds like seasonality, sentiment, and cycles. And we're seeing some divergences in the NASDAQ where you don't have as many stocks that are participating as the NASDAQ has made a new high recently. So there's a divergence going on there. And when you have typical divergences like that normally leads to some short-term pullbacks. We do believe that we're in a new bull market, just like we were in 2020 and 2021. But this bull market will have ups and downs. We'll move forward 2 steps and pull back a step. And we're right now in the process of taking that 1 step backward right now. But this is what this is going to do. It's going to clean the decks and allow you to really focus and find the true market leaders that are in the market today, such as Celsius that just reported after the close. And I believe that's up about $20 after the close. So with that, let me turn it over to Wes, and I'll see you guys in about 45 minutes. Wes?
All right. Yeah, sounds good. So yeah, thank you. I'm just gonna ask for the screen. Okay. Oh, okay, here we are. So yeah, I'll go quickly through. We always touch on the process, just a quick overview of these kind of 3 pillars that we want to consider when making our investment decisions. We'll start with technical analysis. So this is really about price and trend primarily, and we'll go through a few of these things in charts in the back, like the MACD, maybe the RSI, or just the trend in general. We'll talk about participation, so that breadth number, which is an important thing, to gauge the health. Again, sentiment, that's kind of a headwind that Roy touched on a second ago, where sentiment was certainly getting a little frothy. And we can see that in some of these measures that we look at on a daily basis. And then ratio analysis, which I'm not sure if we have any here, but we just want to see relative strength, basically, is what we're talking about with ratio analysis. And then our second, pillar really is this fundamental analysis, and it's kind of grounded in the CAN-SLIM acronym, which Roy went over also just a few slides back. And it's just, we'll send out these slides to you guys, so please go ahead and review this CAN-SLIM acronym if you're unfamiliar, but it's just the kind of key ideas that we're looking for in new leadership of stocks. Okay, and then our third pillar, we look at macroeconomic analysis. It's not as important to us because a lot of times stocks are going to lead the economy, right? Or they always will. That's what they do, right? They discount what they expect in the economy. And but this is kind of a very high level framework, which is robust and can help you kind of guide you through the investment landscape if you know what quad you're in, or if you think you know what quad you're in. And this is kind of based on Hedge Eye Research. We subscribe to them for their economic data. We think they've got good economic data. And right now, I think they're saying we're in quad 3, right? So we'll go over that too, because CPI is coming up on Thursday. And so what we're going to probably see is inflation picking up on a year-over-year basis, and we'll talk about why that might be happening. While growth could be slowing, right? Growth is not slowed at all in the first 2 quarters. We've seen stocks rally alongside that. So we'll see though, right? If growth slows in quad 3, and we are in quad 3, then we can talk about on the next slide what kind of things might perform well in that. So that would be stagflation. So that would be commodities, gold, fixed income that would do well in this particular quad if we are there again. We could end up being in quad 2 if growth picks up and inflation picks up. And in that case, there's a lot of good investment opportunities, but I think it's a little unclear kind of where we're going to be for the remainder of this year. But anyways, it's kind of, again, we try to use this to stay on the right side of things and kind of guide us to some extent, but in reality, you just have to watch the stocks anyway. So that's what we focus on is stock participation. And are you making money, right, in your new purchases? And if you're not, then you should probably scale back. And if you are, then that gives you some leeway to invest more and get more aggressive. But right now, I think we've seen, right, in recent action with this pullback, there's been a lot of volatility again in these individual stocks. And so anyways, next I want to go through a few of the kind of key things, sort of newsy things too, just because they're relevant in the last few weeks. And so I figured we touch on this too. The big news, I think last week, August 1st, was the credit downgrade, the U.S. government credit downgrade. So, naturally you want to go back and look at, what happened in the past when the U.S. debt was downgraded. You can see here, right, pointed out in that 1-day decline, the NASDAQ was down 5%. The index fell another 7.5% in those 1, 2, 3 days or so following that downgrade. And I think it's very common. I'm sure everyone was kind of looking at this. If you guys are really paying attention on a daily basis like we are, naturally you want to look at this. And what's interesting, I think the key difference that we want to note is that this break in the index, this severe break below the 50, below the 200-day, all these things had happened right prior to the actual downgrade. So I'm not sure if that was people front running that information, knowing it was happening, but it's obviously a very different chart than what we see today. Nonetheless, it did put some pressure on things, and it's possible that is leading to some of this weakness in the market recently. We did see rates spike as well with that, right? Because the creditworthiness of the U.S. government is getting worse, then we should have to pay a higher rate. But here we are again. Just there's a very clear difference in the charts. We're just hitting the 50-day. It's the first time in this rally, really, right? Because we kind of consider the bull market beginning in May. If that's the case, this is the first time we're hitting the 50-day moving average. And so far, so good. We'll see. I think that there's potential to undercut it for sure. And Roy, I think we were saying this sort of 13,300 level, right? This is kind of the next level of support. Undercutting the 50-day briefly might be a target, and because right now we've only gone through about a 4% correction or so from the top. So it's not, it has not been very deep. I think that will get us to about 8%. And we'll see in this next slide, right, just reviewing kind of the pullbacks that we saw in 2020 and 2021. So 8% would be, somewhat average, I guess, of a pullback in a bull, at least in this prior bull market. You can see right when the things really got going in the first 2 months, 3 months of the bear market or bull market, we saw these roughly 5% pullbacks. We got our first big pullback in September of 13%, but you can see they kind of barely, you never saw a 20% pullback, right? That would, that kind of puts you on the fringes of a bear market again, right? If you're getting a 20% decline in stocks. So certainly something 8 to 10% range would not be shocking, right? It might be rough. It might be on some of your individual names. We'll see. And so, we've got to figure out how to navigate through these things, because pullbacks happen. The best way to not see your account come down is to sell into strength, right? Either that or you got to buckle down and, or I guess hunker down really, and, I guess absorb those pullbacks to the 50-day. So as long as your stocks are, I guess it depends on what you can sort of tolerate and what your kind of time frame is in your trading. But here's a look at these pullbacks. Again, we're barely even starting, and clearly we undercut the 50-day a number of times in these pullbacks, right? Every time with a decent pullback, we're undercutting that 50-day. So it wouldn't be surprising. We might get a bounce, sure, because everyone's looking at that level of the 50-day, but it might just be, a sellable bounce.
And Wes, let me point out a couple of things. First of all, I was having a conversation earlier with Wes, and really what you might want to pay attention to is use some technical indicators. When we use technical indicators like relative strength and percentage of stocks above their moving averages to determine the breadth of the market and how much the correction might come in, how much that impact might be felt in the overall market. It would not be unusual for the market to undercut that 50-day and have a shakeout and just sort of really clean the decks because we haven't had a move through the 50-day yet. And an undercut, and we were really targeting that 13,003 area where we take out 13.5, go down to 13.3, perhaps 13.2, something like that. And we think that might be the extent of the market. Now, it's going to look ugly if that does happen. And, Apple's a perfect example of that. But really what you might want to take a look at is take a look at the MACD and the MACD on the 2020 to 2021 bull market gave you some great signals in terms of getting back in, knowing when to get back in after the correction was over. You can see, and we'll see that, I think, on a couple of slides that we go over, where you can look at that MACD, and it's going to look ugly, under the 50-day, and you might be tempted to just sell all your positions. And that's in retrospect, that's probably going to be the wrong thing to do. So we will point that out in subsequent slides.
Yep. So, okay, this is something to be aware of. I think Roy said something about seasonally weak period. Yep. So you can see August, September being the worst grouping of 2 months in a row here, and it certainly has lined up. You wonder if the credit downgrade too, it happened in August last time. I don't know if there's something about August, but perhaps there is, as far as vacationing, and they might actually target that month to put out bad news. But this is a look at the kind of worst 3-month periods too. So right, August to October, entering that bad 3-month period. The good news is, of course, once we get out of that, October to December really being our best 3-month period. So, it does kind of set us up, I think, to have this perhaps choppy environment for a couple months. There's going to be a couple other things that we talk about that might indicate why. I think inflation and CPI reports coming up are going to add to choppiness, because I don't think you're going to keep seeing it go straight down, right? The CPI number. So that might add some confusion, right? And we're going to have to wait for the Fed to talk and see if they're going to keep doing what they say they're going to do, or if they're going to, definitely pause. But we're in this seasonally weak period, and it's certainly started out that way. So something that, we can all be aware of. We'll talk a little bit about sentiment here and how it was getting overly bullish. This is the National Association of Active Investment Managers survey, and it's a survey of showing how net long active managers are. And you can see when they're 100% long, right? That's typically a sort of high point, right? Because you can't get any more long than 100%. I mean, you can, marginally, sure. And we did see that exceed 100% here just 2 weeks ago, and that did coincide with pretty closely with the top. The good news is, with that pullback that we've had in the market, we did see active manager exposure come down quite a bit. So now we're at 78%. And anytime, as long as we're not still long, right, we want to see some air come out of the balloon a little bit here, so that then we can make the next push forward in the indexes. So so far, natural reaction. We're not thinking too much of this yet. You can see here, back in 2020, the latest bull market, we did have it exceed 100% a number of times. We saw that exposure come down to maybe 50% a couple times, and then quickly kind of rebound and propel the market forward again. So again, so far, nothing outrageous. And we'll look. This is the AAII bull bear sentiment. We've seen that bear sentiment get really, really low. We've seen bull sentiment pick up quite a bit, which is not, and it's not a great timing tool. We do want bullishness. We expect it to persist in a bull market. We expect bearishness to dissipate in a bull market, because as price goes up, I'm sure that people will capitulate, and we did see that capitulation actually from some big banking institutions, right? So maybe you knew Morgan Stanley, their initial forecast was for a rough start to the first half of the year, and then that didn't come to fruition, and now he's changing his tune. What Mike Wilson at Morgan Stanley, right? So he's changed his tune, and now he doesn't expect a recession. I think maybe Bank of America said the same thing. So there have been a few big institutions that have kind of changed their mind and on their expectations of the economy. And so now it's a little less clear. I think they're getting a little bit more people that are jumping onto the soft landing scenario, and as that happens, you just see that kind of in the market action that there was some good amount of bullishness. And then here's the put call ratio. So a ratio of puts to calls. So if there's more puts, that ratio is higher. That's going to signify more fear to the downside. This is also telling that same story in mid to late July, where there was kind of a low number of puts to calls, right? That was getting close to that red line, which we consider an extreme level. And right, we haven't seen that level in almost 2 years, right? So with this pullback, naturally, we're seeing it pick up again. So once we get to 1 to 1, right, that's kind of that neutral area. But it's again natural reaction in this sentiment gauge also. So again, we want to see that, right? We want to see that if we maintain any level of complacency while the market comes in, that might mean more pain. But the more that this reacts, the quicker that this pullback could be over.
And Wes, let me also point out one of the charts that we sometimes include in the slide deck. It's the implied volatility of individual stocks, leading stocks, the big cap stocks like Apple, Google, Netflix, Microsoft, Tesla, and so forth, and along with the S&P and the NASDAQ. And those numbers, the implied volatility, there's implied volatility premiums, and they're substantially higher than they should be. And what that means is that's going to protect the market on the downside, because people are buying puts, and this is the time where they're buying protection, and it's expensive. And the market typically bottoms when you have are you pulling it up, Wes?
Yeah, I'll pull it up. I might as well. Yeah, this is something from Hedgeye that we look at on a daily basis, and they update these numbers
right here.
So yeah, so these are you can just look at these numbers, essentially these left column numbers, And what he's saying, yeah, what you were saying is if you're paying high for puts, you're paying a premium for puts, it's because you expect higher volatility than's been realized. So it's kind of, it is like a gauge of fear, right? And
It's very,
they're
very
extremely high,
expensive.
bright green.
Yeah.
Yeah.
And you want to be buying the market when you have implied volatility discounts, not premiums, just the opposite.
Right. So and part of this is that it's implied volatility over realized. So certainly realized volatility has been super low. That's part of that, right? It's part of that big green number, because realized vol has been so low, but it is still.
And this
It is
is
still
just
elevated.
this is just something that's naturally occurred as the market has matured and more participants have are involved in the market. And what most money managers are doing, and hedge fund managers, mutual fund managers, they're buying individual stocks, but they're hedging it not with the individual stock risk because of how the meme strategy has blown up a number of these managers. But they're buying stocks and shorting the indexes, and by shorting the indexes, that puts a floor underneath the market, and that's how the market has transitioned, the last 5 to 10 years.
Okay, so we'll go into a little bit of macro just because it's coming up Thursday. CPI got a great number in June, hit that 3.0% number. These next 2 months, you'll see this pickup, right? This acceleration kind of on a year-over-year basis. And this is based on the Cleveland Fed numbers. And so I think, what this does, it does throw a wrench into things. It throws some ambiguity, into the Fed's, next policy move. I think that this Fed nowcast is widely followed now, but I think that they're going to be pretty accurate. And the key thing here is, right, since we comped June of last year at 9.1%, so now the comps just get a little bit tougher. So, naturally, if the comp gets that's 0.6% tougher, you might expect all else equal this to go to 3.6% in July, if that makes sense, and then 3.8% in August. But anyways, there's a lot going on, but I think that what you're going to see is this headline pick up. We've all seen the oil prices pick up, and prices at the gas pump increase a decent amount in the last month. But I think if you're going to get any bullishness out of this report, it has to be from the core CPI number, which I think you're going to actually see that you might see that deteriorate or like decelerate. So if you're going to get that, I don't know the reaction. Reaction is going to be tough. Who knows, right? But if you can get bullishness, I think that you're going to get it from the core number decelerating. So that's what you're going to get, a little bit of mixed action in the CPI report. But just a reminder, this is something we've showed a few months down in a row. This is the PPI versus the CPI. So the PPI in orange. The PPI is pulling this down, is going to pull down the CPI. Some of the issue with the CPI is that there's more services in that, right? So that keeps it a little bit sticky. We know wages have kind of stayed at that 4% increase level, so which is a little bit higher than normal. So, but I think that this simple chart kind of says most of what we need to know. Anyways, it's just stuff to be aware of, I guess, for Thursday morning. Okay, and wanted to show kind of what's the big fake out, I guess, that it looks like we've kind of experienced in this growth improvement and improving environment, right? So stocks started to make progress in May, if you bought some things in May, and then continued in June and July. And then since then, we've got kind of a wicked pullback in this IBD 50 ETF, right? We've come in from 27 to 24. So that's 10%, right? So as that index is coming in 10%, that's, the stocks coming in at least 10% from the peak in mid-July. And this is, this is the gauge, right? This is the gauge of the environment we're in. And if growth is going to work, if this is going up, growth is working. IBD stocks, can slim stocks are working. And, it's come back to this breakout level just today, just completely come back to that level. And in a similar respect, we looked at ARC last month too, which had a really powerful breakout as well. I think if we had the volume, I think we did on the prior chart for ARC last month, but the volume was real high and it broke out with some force above that 45, 46 level. And that has looked really the same as FFTY, right? Where it's giving it all back. It's kind of a breakout, coming back to the breakout point. And so, if we are in a new bull market, you would think that this would hold. The indexes could still come in more, but that's kind of what you expect, right? This is not a typical action. If you bought it right, if you chased up, then you're in trouble. But if you bought this right, you've given them back your gains. But this is where people could step in, where buyers could step in. But also we're looking at this MACD clearly still on a sell signal. So, that's kind of been a theme. We'll look at the MACD here too with the NASDAQ. Also on a sell signal. We peaked back in June on this MACD. And we're not oversold yet. We're still kind of working through this in this correction though.
And we may just need some time here, guys. It's for us to work off the total, overbought condition, and we are in the process of doing that. It just may take a little bit of time, but you can see these prior inflection points. Take a look at the MACD. We're really focusing on like when the next buy signal will occur, and that'll give you a better idea that the coast is clear. So we don't want to be too early in terms of just getting in there buying heavily here when the market still has a potential way to go to alleviate the overbought condition fully.
Okay, here's a little bit of a zoomed in look at the NASDAQ and the moving averages we look at. So the 10 in green, the 21-day in magenta, this yellow 50-day and red 200-day. And so, yeah, with this pullback, that's close enough, right? We've hit the 50-day basically today, got to bounce off of it. And that is, I don't know, it's natural action so far. We'll see how it responds at this level.
We've also had I think this was the 6th distribution day. So it is a bit worrisome that, we've got the 6th distribution day right here. But, recently in the last few years, the market's been able to withstand in a new bull trend, 6 to 7 distribution days. But you can see some of these closes over the last month, how poor the action was in the market, where we opened higher, went higher, and closed at the lows of the day. So that's why we think that you potentially need to wring out a little bit more of this excess and just get the fear level a little bit higher, and then we can make the next move higher in the indexes.
Yep. Okay, so here's the NASDAQ and the 30-week moving average, just our long-term trend. Really no update here. We've been in that uptrend based on that measure since January of this year. And okay, here's the stocks above the 50-day for the S&P 500 down here. So we were up at that 90% level, very high, right? Very high level. Another, hint that you're getting close to overbought and could expect some pullback, right? Because every time you hit that 90% level, that might be that's a warning sign, right? We're coming into 60%. If we stay at 60%, that's fine, right? We just need to stay above 50%. we need to stay above 50% to really sustain, I think, a bull market. And here's a look at the S&P stocks above their 200-day moving average. So again, natural kind of decline in that number over the last couple of weeks, and I don't know, nothing to highlight there too much. Here's the NASDAQ and the stocks above their 50-day. And this is getting below 50% here in the last day or two. And you can see there's that kind of negative divergence, right, where there was less participation in this last move up in the indexes, which I think we talked about quite a bit too, in June and July, and really a lot of this year. And you're going to see that same kind of negative divergence here with the indexes, making a lot of progress, but not seeing really confirming action in this participation measure. Okay, so yeah, we don't pay as much. I think we pay the least attention to the advanced decline line. The S&P actually is showing, some confirmation there as far as progress, or as far as breadth. And the advanced decline line with the NASDAQ, not really, but just another way to look at these things, breadth. But this is really our, the best, I guess, measure of breadth. This is the measure. This is how you know if you are in a money-making environment. If you're in an easy dollar environment, you want to see more stocks making new highs versus new lows, which is, I think, pretty intuitive. And so right here, we've got this new high in black and new lows in red. And then down here, we have the difference. So when we have blue, we have more new highs versus new lows. So we did see some improvement in January. We thought we had really seen the start of the bull market because there was a ton of participation. It was a real strong start to the year. He got kind of faked out with the bank crisis. And then things didn't turn around until mid-May, when you started to see kind of a few more things happen, right? A few more stocks making new highs and new lows, and that was a pretty decent run in the indexes from May to July, and now we're getting this pullback and we're seeing the new lows pick up again. But we don't think it's something that it's not at an over alarming number still. And
Wes made the point about John Boyd's course where we featured this indicator going back the last 3 decades, and also with Matt Caruso's work as well.
I guess what point exactly do you mean? Just that?
Yep, the idea that we featured after the latest bear markets since 1990, I guess. We featured
we did
what these look like.
We did take a look at that. I think we must have did we do that in June? I think in the June meeting. Yeah, we went over that with the IBD group. So you can always check out the replay there. We did look at, I think it was 6 different bull markets. So coming out of bear markets and new bull markets, seeing what this net new high looked like. So you can definitely review that June meeting where we go over a lot of those. So again, those 6 time periods, and then what the new, what new leaders looked like also during those time periods. I think we looked at like 5 to 10 stocks in each of those new bull markets too. So you can look there. You can look at Trader Lion's conference as well. They hosted a conference in early June where we were on there. And so we talk net new highs, same kind of thing. In that June conference, Trader Lion on YouTube. And then also if you look at Matt Caruso's, yes, he loves this kind of indicator. And you look at his segment in the Trader Lion conference as well, you'll see him discuss and kind of, he might have a little different take on the net new highs. And he's he knows what he's talking about. So definitely worth a listen.
And the primary takeaway of those comments is that our friend John Boyk has always said it's almost impossible to make money when new lows are exceeding new highs. And you can just see what's happened with the market environment over the last 6 days. So it's important to know what's happening behind the scenes in terms of putting everything in context. And, you can see the new lows eclipsing the new highs and over the last, 6 days. And gee whiz, stocks aren't performing very well. So there's a very strong correlation between you making money by having the market at, the wind at your back versus, having a headwind. And the new low list right now, currently, it's a headwind.
Yep. So this is a measure we're looking at every day too, to kind of give us an indicator of overbought versus oversold. And it's the McClellan oscillator. So we're looking at this, we're kind of keying into this to see if we get an actual, real oversold level. We were close here, which was just a few days ago, to showing really oversold. Anytime we're at minus 150 or so, that's when we're gonna, that's when we really consider it. And that's something that I think it has had a pretty good track record of calling some of these snapback rallies. And just also to note,
yeah.
What?
Go ahead.
Well, I was going to say it was also overbought in July, right? As another hint, it was overbought a couple times in July. Yeah.
And the usefulness of this as a technical indicator is if you take a look at the February 2023 to March 2023, that sell-off right there from and there's really that actually began in the middle of January, but we had this major sell-off in February, the beginning of February there to the mid-March, and the S&P came in about 300 points. And so the S&P, I think we've come in about 100 points so far, which is consistent with, the April to May pullback before the market started engaging in gear in mid-May when the new high list started to expand. So we're close to having a potential bottom, but we just don't know if there's going to be one more wiggle to the downside, or not. But so far the market's come in 100 points, and other times since May the market came in right at 100 points as well.
Okay. So here's the VIX. We're noticing the VIX, right, when it collapsed in June and July, it really made it for a much better environment for the market. We've seen that pick up. We saw that pick up with the U.S. credit downgrade, and the volatility of the volatility has also picked up, right? It's going a little bit all over the place recently. And I mean, it still looks to be in a downtrend right from here. It's hard to say otherwise when it's below, it's been trending down since October of 2022, really. But a pretty decent spike today with the action. We could get one more. That's what we're kind of wrestling with. If we do get one more, it's certainly possible. But and just here's another look longer term at the VIX. We want to stay at this 16, really below 20 for sure, but in this sort of 16 range, you can actually trade, right? And so that's what we're that's kind of the, what do you call it, the bucket we want to be in, under 20. 10 to 20 would be an ideal environment for stock trading. Okay, and this is the active manager exposure I went over earlier in the presentation. So a few sentiment things in the back that we already touched on, these put calls as well. Okay, here's a look at the high yield spread. So, credit risk was in the headlines, right? Last week with the US debt, a little bit more in the headlines this morning with Moody's downgrading some of these financial institutions as well. So actually, I wish this was updated for today. This is yesterday's. It hadn't quite updated yet. So this is yesterday's number. This 3.97. This is a high yield spread. So as that number increases, it signifies a greater credit risk for corporates. And so this is an index for that measure. But you'll notice it hasn't perked up a ton, honestly, considering the US credit downgrade. I mean, the thing about the US credit downgrade is you would think it's not like Moody's or whoever, S&P, or I can't remember which one did it. It's not like they uncovered anything that wasn't already known. They're just shining a big light on it, and making headlines, because they rarely do that. They rarely, will take that step to downgrade. So it's interesting that all this discussion about it, when the market theoretically should have been pricing that in from the beginning, the downgrade. But anyways, something that we look at for credit risk, we want to see, if this shows any sign of worry. You'll see what happened in March, right? When there was no downgrade of credit or anything. This is just the market seeing what's happening with the regional banks and that spread and that perceived creditworthiness, deteriorating in March until the Fed stepped in. So we have not seen that action here. So I'm not sure if the market sees something we don't or what, but just something we keep an eye on. Again, credit kind of confirming or refuting, I guess, the stock market action. Okay, and this has been a headwind, right? We know that in 2022 the story was rates. That was the major headwind that we had to contend with for the market, right? Because all of a sudden all this money that was in the market, you could get a decent return for the first time in a few years by going into treasuries. And we saw that big run up here in the last week where it spiked to 4.2%. It came in quite a bit the last 3 days. So just, the news, I think right here of the US downgrade took us from 4.0 to 4.2, which is a huge move in just a short amount of time. But coming in, so we'll, we don't want to see this make new highs. I think if this goes to new highs, breaks out of that 4.33%, then it kind of, I think that it becomes a major headwind again. But for now, I don't think this is really the story. But yeah, we don't want to see that. We don't want to see that get loose, and then people have to question how high is it going to go again. Okay, and this is the last slide of our presentation and the last chart. We wanted to highlight Bitcoin. I know we talked about this last month too, finally, because it's just the action in it has been so amazing. The way it has rocketed to new highs in each move up, and then this most recent one in June. So we're looking for that turn. We thought right here this was the breakout, at 31,000 or so. It looks like it was a fake out, but I think we are going to get this thing to turn. It turned yesterday, right? And it's it's showing strength relative to the rest of the market. So if you think it's a commodity, if you think inflation is going to pick up, this is actually one of those things that could theoretically do well in the back half of the year. If you think inflation is going to be sticky and we're going to be sitting here at 3-4% for the next 6 months or so without any real progress. So definitely an asset class that we continue to kind of keep on our radar. I think we do actually own a little bit of this in our company's fund. So yeah, anyways, this is something for sure that I think is worth noting. And that is it. I guess I can hand it back to you, Roy, or do you just want to take a quick break, 5-minute break, get back here at 8 o'clock?
Give me 1 second. Let me see it. Let me get my screen correct here. First of all, are there any questions so far? Would any of the members like to just interject some of your comments, some of your thoughts in terms of what you're seeing in the overall market? What do you think about some of the ideas that we discussed? So we'll open the floor and answer any questions. Have a dialogue if there is one, and then we'll take a 5-minute break after that. So the floor is open.
I have a question. Can you hear me?
Yes.
I wonder, Roy, what do you think the chances are percentage-wise that we undercut the 50 and hit a couple more resistant levels past down below the 50?
I think there's a good shot. If I were a betting man, I think that we do I think we're not quite there, but I think we're close. We're close. We just need to have, one more leg down. If you see stocks like NVIDIA touch the 50, and NVIDIA broke the 21-day today, and you can look at Apple's performance, Microsoft. So it's kind of sketchy action out there. And with the breath cooling, I wouldn't be surprised to have an undercut, and that undercut would really shake out a lot of people and set the stage for a new upturn.
Makes sense.
Any other
hello.
questions? Go ahead, Francisco.
For assessing the market, what about the action of leading stocks? Or don't you look at that?
Absolutely.
And also sectors and industry groups?
Absolutely. What we typically look at, and I'll share my screen right here. And this really, this is William O'Neill and Investors Business Daily proprietary methodology. Do you see my screen here? These are the top 200 composite stocks. Do you guys see this? Just let me know if you can see it or not. It's a Market Smith chart. Do you see that?
Yeah, yes, we see it.
Yeah.
Okay. So, and this has been very, very valuable over my career. And Investors Business Daily, using Market Smith, you can screen for the leading stocks and then the leading stocks in those leading industries. So there are 197 industry groups according to the way that they calculate, the way that they organize industry groups. And after the sector approach, they break it down to sectors and then industry groups to get down to the nitty gritty. And the composite rating is a proprietary measurement. It's a gauge of how Investors Business Daily ranks stocks. And it's based on a number of factors. It's based on their earnings per share rank, relative strength rank. It's based on industry group, its strength. It's based on sales, margins, return on equity, and there may be one or two more criteria. But typically, the stocks that have the strongest composite rating, and these are composite ratings you can see here on my screen. These are composite ratings of anywhere from 97 to 99. These are the strongest fundamental stocks. Now, this is what happened today with the strongest rated fundamental stocks in the database. That database and these stocks were absolutely torched today, just across the board. And many of these stocks have had nice moves, and we have considered these stocks to be leading stocks like Li Auto, MDB, HubSpot, Adobe, Palo Alto Networks, which just had a major blow up, I think, yesterday. Datadog, DDOG, was on the list as well. But this is the distribution that took place today. So you have really their top performing list of stocks, and this is what happened with the stocks today. And another measurement to give you context to see, well, what's the overall market is doing is we use this Market Smith Growth 250 list. And this is a proprietary screen of a number of screens that I think Mike Webster designed this. And I think there are like 13 screens that comprise this one screen. And it's designed to get you in to the top performing growth stocks, in the marketplace. And you can see Super Microcomputer has had an amazing run. We just sold this a week ago, but it was down $50 after the close tonight. And they had an amazing quarter, but it's sort of a sell on the news effect. But they had an unbelievable quarter, gave great guidance and said demand is unprecedented in the AI area and in the area that they do business in. And so this is what happened today with a lot of the leading stocks. So there was quite a bit of distribution. So this will give you an idea of what's happening under the surface. But this screen ranks the stocks by, first of all, by industry group. You can see over here, these are the top industry groups in the market currently. And it's designed to get you the top leading stocks in those top industry groups. Bill O'Neill writes in his book that he prefers to just buy stocks in the top 4 or 5 industry groups. And so by doing that, you are going to get the de facto leader. But we think NVIDIA is the top stock in the market, currently because of its liquidity, earnings growth, and their revisions upward that they just made in the last quarter. But this is a great screen to really get the top performing stocks in the marketplace. But this is what's happening under the surface, currently.
Hey, Roy.
Yes.
What, if you don't mind me asking, what percentage long exposure are you guys at right now? Last time, I think. Yeah,
we're 70% right now.
Okay, thank you.
So, and we stopped ourselves out of a number of stocks today that we got hit on, and that we were trying to hold, such as Shopify, Dexcom.
You still own Palantir?
We still own Palantir, and we will talk about Palantir when we pull up individual stocks, but we do own Palantir. But we kicked MDB out along with Snowflake as well. So
what took you out of SMCI last week? And good for you for getting out of it. But
really, the technicals, and it had just an amazing move going into the number. We did buy it at 123 and sold it at probably 230, and then we bought it back at the 21-day, and we had about a 40% gain on the second time that we purchased it. And the technicals, looking at the MACD and some other technical indicators, led us to believe that it was potentially peaking right there. So that's why we sold it. And we sold LI yesterday for the same reason.
Good for you guys. That's great. Yeah.
So let's take a 5-minute break, guys, and then we'll come back and we'll talk about individual stocks. Okay, guys, let's go ahead and get started on the second half. This is really what we really think is a lot of fun in the program. It's discussing individual stocks. So let's take a look at the market and some individual names. And really what we're trying to do, our entire philosophy, and many can slimmers, the philosophy is to try to find and get some of these true market leaders. And these are stocks that beat and raise their earnings numbers, their earnings guidance for 8 consecutive quarters or over 100 weeks. And it's been shown in the past that the average true market leader, runs a couple of years. And typically you're going to have a stock that increases its earnings guidance, raises the numbers, and they continually beat during that earnings cycle to get these stocks that can go up 200 and 300%. And that's what we're trying to do. We're trying to get 10% positions in stocks that can double or triple. And by doing that, you get kicked out of a lot of different holdings because a lot of stocks don't work out. In fact, 50% of stocks that we buy, that traders buy, they are wrong with. So, so you can't confuse genius with the bull market. Bull markets make us all look like geniuses, and bear markets and pullbacks make us look human and frail and powerless and foolish in many times, because many of the stocks that you can sell, that you do sell, they can turn around and go right back up, and you wonder, man, why did I sell that? But it's just through risk management. At some point, you've got to limit your downside. We typically try to limit our downside to 1%, not necessarily a 5% or an 8% stock, but 1% of capital. So, if you have a $100,000 account, you don't want to risk more than $1,000, on that particular stock. That's the way that we frame things. And of course, that's, a $1 million account, you don't want to risk more than $10,000, on a position. So you have to have risk parameters in mind, or you can take, very, very significant losses and drawdowns, which is what you typically want to avoid. So let me just show you what's going on in the market. Datadog, that beat and raised numbers last quarter, has been really one of the turnaround situations in the marketplace, using their data analytics and their cloud platform. And the stock dropped 17% today, just on the earnings report. And that had a material effect in the cloud computer networking group. So that affected stocks like MDB, breaking the 50-day. And by the way, MDB, they beat their earnings estimate. You can see the gap up last quarter by, I think, 156%. So you typically find the best performing stocks are the ones that beat that beat the numbers by the most. And so that's why we own this stock at 405 and had to sell it today, going through the 50-day just for protection purposes. And with earnings coming up 23 days, but this was a casualty of Datadog's report. And then another stock that blew up yesterday was Fortinet. So Fortinet, or 2 days ago, Fortinet looked great going into the numbers. And this is a security company in the same group as Palo Alto Networks, CrowdStrike, Fortinet, Zscaler. Those are the primary leaders in that group. But they came out with a disappointing quarter, and they guided down. And you would have never expected that to happen based on the stock chart. But that's what happens when these growth stocks miss and guide down. So this stock was down, I think, 25% in the 2 days ago, and we got caught in Palo Alto Networks, that where we had bought it back and bought a little bit more than 50-day 3 days ago, and then Fortinet came and we kicked this stock yesterday. I believe yesterday we had to sell it. Or we could have sold it the day that it dropped. We sold it yesterday or the day before. So you're getting some of these blow ups, and these are stocks that look great. This is Teradata today, TDC. So look at that nice uptrend, and then it just got pummeled today, on the earnings report. So that is, that's some of the things that you're going to have to contend with, and there's no right way of handling it. And you own the stock because you think that the quarter is going to be good. You've done some fundamental research, but there are many different things happen, and you just have to change your opinion when the news changes. So keep that in mind. Duolingo, DUOL, it did report today, but that broke the 50. So a lot of these growth stocks, TMDX, they're under pressure. See, they looked fine, and then in the last 4 or 5 days, they've really come unraveled. And this is just a symptom of the new low list expanding, and stocks that were building bases, they just rolled over. So let's talk about Palantir. Palantir, this is one of our largest positions, and we started buying this stock at 11 right there, and we've averaged up in the stock a couple of times. We pretty much averaged up in the stock, and then they reported their earnings, and Palantir has a platform that's designed, they're the #1 artificial intelligence platform really on the planet. They've got a partnership, or they've got a client base that consists of the NSA, the Department of Defense, Homeland Security, and they use all their artificial intelligence tools, and Palantir is branching out into other areas like transportation, hospitals, drugs, and other segments. You can find the segments that they're branching off to in their website. But Palantir hit their number, and they gave very conservative guidance moving forward. So we think that this can be a real big stock over the next couple of years, but they're going to have to continue to grow their revenues and grow their earnings base. So the CEO said they had about 300 engagements in the quarter. So 300, potential clients they've had conversations with. They've got to convert that and monetize that into their numbers for Wall Street to get on board. There's quite a bit of sales on the stock, which is good because they're going to have to convert over, and there are a number of buys and reiterations that just took place. Most importantly, the Wedbush analysts raised their target to 25 about a week ago. So we think the stock has great potential, but it's going to take a little while for it to build a new base. So here it's somewhat treacherous, but it did hold the 50-day. So it just needs to build a base. The big money is going to be made when the stock closes back over 20. So when the stock closes back over 20, there's going to be a rush of short covering that's going to propel the stock, what we think, higher just from a technical basis. So keep this on your radar. Keep this on your radar screen. And I also wanted to mention Celsius. We've been talking about Celsius forever, for the last 6 months. Celsius had a tremendous quarter, and they make the energy drinks. They compete with Monster, and they had a great quarter. They beat their estimates by about 30%. They blew the numbers away, and you can see they had 112% revenue growth. Earnings were up 300%, and the stock is gapping up after market. You can see the stock's up $21 after market. This is one of our larger positions, and we'll probably press it tomorrow. We'll probably press the stock tomorrow. We had a 7.5% position. We sold it down to 5 just to reduce risk going into the quarter. We were up in it about 22%. So we're gonna add some more exposure to this stock. So this stock is exactly the way you want a stock to act going into or after the quarter. Where there's tremendous institutional demand, big aftermarket volume. So watch this stock to potentially move much higher from here going into the next earnings quarter. But they had a great quarter.
Roy,
Yeah, go ahead.
do you think that you're going to get some power buying on that stock tomorrow because it's so shorted? So you're going to get a lot of covering possibly happening tomorrow.
Yeah, no, this is Joseph Ebnith, and we've talked often about these stocks that are up 10% in price, that were volumes up 300% more than normal. We look at those stocks. I mean, those are stocks that are so powerful that they typically move higher. In fact, NVIDIA had that. You had Eli Lilly and Novo Nordisk had that characteristic signature today. And, that's really one of our favorite buy signals in trying to identify stocks where there's tremendous institutional demand and they're going into all-time highs too. You put all that together, and that can lead to a very robust return in a great stock. So and normally what you want to do is you want to watch the first 15 minutes of trading, Brad.
Okay.
And use the 5-minute bar for the first 15 minutes. So that's going to be 3 5-minute bars, and watch to see how it reacts. And, a trade, many day traders use this technique, and we use it for follow-on purchases as well in a hot stock. We want to see, we're going to wait for the first 3 5-minute bars. And then if it takes that out, we'll press the position.
Because I'm looking at
you're not going to want it. You of course aren't going to want it to close the gap. So it needs to have if this stock goes higher all day, we'll press it all day. But we're not going to turn around and buy, I think, 5%, on the open. We're going to buy 1%, then 1%, all day. We're going to buy it if it continues to move up.
Yeah, so you're saying it needs a proof to you that it's going to keep going and just not fade and close the gap. Right.
Yeah, exactly. Because you can get
in this market, a lot of stocks are doing that after earnings. They fade and close their gaps, their earnings gap.
And there's DraftKings, if you can see that on the screen. See that gapped up perfectly, and and they sold right into it. Now DraftKings was impacted somewhat after the close when Penn Entertainment signed a deal with ESPN, so the stock's having a little bit of weakness. But they had an earnings surprise. I think they had like 100% earnings surprise. It was a big number. I don't know exactly what it was off the top of my head, but that's what got the stock going. And so this stock has tremendous numbers, but you have the idea that competition's coming in that impacted the stock after market. So we'll see how that goes. But we actually press this stock on the move there, so we're underwater in it a couple of dollars. We did press it on that breakout to new highs on the earnings news. And I talked about this stock as well, RELY, and this is a stock that gapped up. It had a beautiful breakout and gapped up on the number, and then they sold right into it. See, so you're having a great chart. You're buying the breakout perfectly, and then they sold right. I mean, but if you bought the stock at 21, you could have been up 20%, if you bought it at the open, if you sold it, for a gain there.
Mhm.
LI reported, LI just really had a fantastic quarter, but we sold it yesterday just because it was so extended going into the number, and we bought it, I think, around 38, and we had a 17% profit in it. And you never have enough, when you get those moves, but we didn't want to hold it into the number. We wanted to just take the profit, and this stock had just a tremendous report. It's actually looking much better than all the other stocks in that universe. It looks better. See, this stock is close to having a 3-year breakout, to an all-time high, versus XPEV way under the all-time high. And who's the other in the group? NIO. So you want the stocks that are close to all-time highs, and those are the leaders. So we view this LI as a leader in the EV group, but it's just a little bit of pause and congestion here as you go through this digestion phase right here.
Hey, Roy, this is
Yes.
Ferris. I have a question. So obviously you think SMCI is a true market leader, potentially
Yes.
Li Auto as well.
Yes.
I guess the question is, do you sell completely out of it when you think that a stock is extended going into earnings? Or what's your rule, or do you have any rule in terms of how you potentially get back in if it starts to reach a certain price?
Yeah, that's just really there's an art to that, Ferris, and it's really an art. Now, true market leaders, this stock has gone up from 100 to 350, and this is probably one of the biggest moves up, where the stock made a new high, 52-week high, and then continued to go. But it's only gone up 3 months. It would be, just from a historical perspective, it would be very unusual if this move is over. So, if we're in the beginning of a new bull market, it would be very unusual. And with the guidance and the numbers that the CEO provided after market, they were just huge. They're astronomical. And, and we do know demand is unprecedented. Look at this stock's revenue numbers. This stock's just had tremendous revenue numbers, and they're not, I think this is a June number. They sequentially, I think they did over 3 billion, if I'm not mistaken. I'll have to take a look at that, at their earnings number again. But the stock is just, it's going up, 200, it's going up from 200 to, 350 in the course of 2 months. So that's pretty parabolic. It just needs to settle down. Now, the 21-day, you might look at this 21-day as an entry point. So that's 313.71. There's a reason this stock's at 315 right now. So it's, the stock's going to probably open right there at 313 at the 21-day. And then you'll just have to decide, or market participants will have to decide, is it worth putting the position back on, right there. This Li Auto opened at the 21-day, then bounced off the 21-day. But, we didn't want to buy it back because we're somewhat concerned about the overall action in the market. And yes, we do think this is a potential true market leader, leading stock, but this is a fault. You're just guessing, that it's going to hold at the 21-day, and that's really it's the faulty base. There's no base there. It's the stock is extended. It needs to set and go sideways, for a few weeks and reset itself.
Hey, Roy, do you mind looking at Ollie's, OLLI? It's been trading really tight. Volume's been drying up. Also, if you look at the daily too.
And Vaughn, I think we talked about this a month ago as well. And, this is what you want to see with the stock. This basing out. So this stock had a very onerous wide and loose pattern. Earnings reported some time ago. It came in and the stocks managed to make a new high with this, this sideways ledge, action. It's looking quite constructive. Earnings are in 16 days. So there's no cup and handle here. This is just really a long base here, just a big base. And, the stock's gonna probably need the earnings to propel the stock higher from here. But so it looks great. Look how well it's holding up in the midst of all these other stocks that have been getting pummeled.
Also, I forget my patterns. Is it significant that the volume's been drying up in this tight pattern?
It is significant, yes. So there's not a lot of selling people or holding on the position, and there's quite a bit. So you've got some nice mutual fund in ownership in the stock as well.
Okay.
This has always been one of David Ryan's favorite stocks. You'll hear him often talk about it.
Thank you.
You're welcome. Let's take a look at Apple, by the way, guys. See, so this is Apple looks horrible. Now, it looks horrible, but it's interesting that the stock never had these can slim characteristics. Bill used to always only buy stocks that had earnings, where you might have 3 or 4 out of 10 that stocks have great revenue growth with no earnings that become true market leaders. But Bill himself, I hear that he never bought stocks without earnings, true earnings. But we never bought Apple this year because the stock didn't have great earnings. Look at the last 4 quarters, up 4%, minus 10%, no growth. The March quarter, up 5%. And, really this has been a market this year, as everyone knows, that's been led by 7 giant technology stocks. That money came in as a flight to quality when the bank crisis was going on. So, you would typically think that banks would be a place to park your money because of the great dividends. But with the banking crisis that took place, money went to the next best thing. Those are the stocks that had the best capital structure. And these were these large cap stocks, that have billions, in cash. And, Apple had a very poor report and the stock gapped down through the 50-day. You've got crossovers in the indexes. And so this is really a sell signal. So this is what's, this itself, I think this is, one of the largest stocks, if not the largest stock in the S&P. So that's impacting, of course, the NASDAQ and the S&P. So there's Apple had a poor report. MSFT had a poor report. It moved up into the number, sold off after the number, and now it's, trading, below the 50-day. But I don't think there's not anything ominous going on here. It's just the market is rotating. So the market's still rotating, out of growth right now into stocks like Caterpillar and some cyclical stocks. And that's just, that's healthy for this market to digest with the rotation. But, the stock's broken the 50, but this isn't necessarily a sell signal. I would think with Microsoft's dominant position in AI, and one of the reasons that it had that nice move to up there is that they're starting to charge $35 for every Office 365 client that uses ChatGPT. So they're actually monetizing it. That's going to be huge. That's going to be huge. So this could potentially give you an opportunity down here. So what you want to focus on is the stock action and the technicals. You want to see, you want to use things like the MACD and the stochastics and things like that to try to get an appropriate entry position in a stock that's under the averages, like, you know, like this one.
Hello, Roy.
Yes. Hi.
Hi. Talking about Ken Slim, Bill, and his books, he recommends not buying stocks that are in industry groups higher than maybe 100 or 50. And usually I see people talking about stocks that has good setups, but are in industry groups higher than 100. And I get confused. So how can I handle those stocks? What do I have to see in order to focus on stocks that are higher than 100 in the industry groups?
Well, you know, what Market Smith provides you with is a mechanism by screening for the best stocks in the top industry groups. And that's going to get you some of the true market leaders. They're going to be on that list, just like they're going to be in the FFTY, the IBD 50 list. They're going to be in that list. You just need to know what to look for and what list to, you know, constantly study, because those lists change. They're very, very active. They change rapidly. But you know, occasionally you will find stocks in a poor industry group, and you'll find a stock that's outperforming other stuff, that's got a 99 relative strength, and it's, you know, it's outperforming everything in the market. And occasionally you'll get an outlier like that, but normally 3 out of the 4 best performing stocks, it's because of the industry group. You know, industry group has a, you know, that has to do with 50% of the gain normally. You want to have big industry groups, and you want to have those industries have, you know, more than 1 or 2 stocks. You want it to be broad. And in a broad market, bull market, you're going to have stocks in those top industry groups that are going to have, you know, 30, 40, 50 stocks, not just a handful, you know, not just 1 or 2 stocks in the industry group. Daily percentage change. So I have this screen here just to show you. And the industry groups, and let me just point this out. The industry group rank. This is from number 1 to 297. And so you can see some of these. So these are the top industry groups: computer, hardware, peripherals, computer, software, database right now. And you want to see stocks that move up in the ranking. That's important. So you can see stocks that move up in the ranking from 3 months ago to today. And you also want to potentially ignore stocks like this commercial services, document management, that only has 5 stocks. You know, so you want these groups to have a large amount of stocks. You want them to be in the top performing group and have, you know, you want to have 50, 70, 100 stocks in the group. And that tells you, you know, that there's broad participation, which is important to propel a bull market higher. That's quite useful from an industry group perspective. But if you look at, you know, if you have a tool like this, you can see, I mean, this is really a go-to for me. And it starts with the top ranked industry groups. And then it does not include stocks that don't have the highest composite ratings and have the best fundamentals. So that's why you have a few of these industry groups that are lower, because the stocks aren't rated as highly. But you're going to get, see, there's super micro. And so I don't know how long this has been number one, but it's in the number one group. It has been the number one stock, and you can stock. When we bought it, you know, this stock was probably in the top 4 or 5. But this is going to keep you, you know, a tool like this is going to keep you on the right side, and you're going to be able to pick up, you know, these stocks that are, you know, these stocks that are moving higher as the fundamentals come in. Yeah, this is this NVO that, you know, they've got an obesity drug and probably a diabetes drug as well. And look at the stock, look at how the stock performed after the earnings move. So this is a very, very large company, just like Lilly, but we're actually looking at buying this stock on a pullback now because it's showing itself. So, you know, this stock's traded 500% higher volume than normal using the 50-day average volume. Stock was up 17%. See, stocks like this typically go, you know, a stock like this is going to, when it gaps up, you know, it typically goes, you know, goes another 20% higher before the next base. Just like Lilly. I mean, big numbers, you know, Lilly just blew it out on the earnings with their obesity drug. And I think that's called Ozempic. Oops. Didn't mean to do that. But blue chip stock that's now participating, and, you know, great, you know, institutions just piled in. You know, this is, you know, big stock, big earnings, great volume, great reaction to the earnings. See, when NVIDIA, see, take a look at here, see what I'm talking about. See, when NVIDIA reported right here, this is a serial gap upper. So that's on the earnings, it gapped up. There's it gapped up. Now we're waiting for the next report to see if it gaps up. But, you know, this is, you know, I view this as the number one growth stock in the market, as many other people do as well. And I think you'll see the stock go to 550 on the earnings report. Now it's right below the 21-day. So this is good. You can see I have an alert here at the 50-day. So it's going to be interesting to see where it goes. That 50-day is 428. So that's down another 20 points. It rallied off the low today, but that's another, you get another 20-point down move. And this is 3, 4, 5. This is today where it rallied. It rallied off the bottom today into the close. But, you know, and you know, it may, there was some news after market regarding the Chinese and not being able to buy AI chips if they do 50% more, if their company does 50% more in AI or supercomputers. And it doesn't look like there's a major effect after market, but you get a move, you know, this would scare people. You know, if you broke the 50, and if any news comes out in the next couple of weeks, and you know, I believe that's probably should be bought on weakness, you know, on a shakeout, because they raised guidance to $11 billion for the quarter. So they raised their numbers from 7 billion. They did 7 billion, and they gave guidance they're going to do 11 billion. And they actually came out with their new chipset, their new CPUs for artificial intelligence today. And you can read about it at the NVIDIA site. So they came out with a new product that's going to be sold out, institutional favorite. So I look for this stock to react favorably to that earnings news. I think this is going to be this will be $1,000 stock in the next, 12 to 18 months. There's some new stocks, by the way, that are acting pretty good, like this POWLC, this Powell. It's only $1 billion company. It's small. It's too thin to buy for us, but you had a great earnings report. I saw that. I mean, you had a great earnings report, and they're in the infrastructure area. Stock gapped up on big numbers, and so it's that 10-day is rising. It would be typically a buy right there, that 10-day. And if it holds the 10-day, it's not going to fill in the gap. Remember, I told you don't want to see Celsius fill in the gap after tomorrow. Ideally, what you want to see is you'd like to see it come in one day and then take that high up. For example, let me show you something. This is one of our favorite stocks. We're trying to get more into it and higher position into it. This is Vertiv Holdings, VRT. And what's interesting about the stock, it's got a $13 billion market cap. And it's doing $3 billion in sales. So it's really cheap. And it's got great numbers. Remember from canceling, we're just looking for 25%. But I found that the greatest winners that you're going to have, they're going to be in stocks that have numbers like NVIDIA, SMCI, Celsius. This VRT has the same type and characteristic that I'm looking for. And see, this is ideal. See, on day 2, see it gaps up. You get a move, an inside day there, and then it takes it out the following day. And look, this market got hammered, and this stock was actually up today. And by the way, one other tidbit, they just priced a 20 million share offering. And normally they price, when a secondary comes, a spot secondary comes, there's the Wall Street needs to price it in the hole. In other words, they need to sell it at a discount. They sold this for $35.10. Which is highly, highly, highly unusual. That means it was a private equity firm that sold 20 million shares and the stock did not go down. Like Wall Street they just got it all. They took it all at no discount. So that's very, very, very bullish action. And I'm very, very bullish on this particular stock that's going into new all-time high territory.
Roy, how would you enter that if you don't have a position? Would you wait for a pullback, or how would you handle that?
I think I would buy. I mean, I would want. We would like to have a 10% position in this. We have 3.5%. So we don't know. The reason that we didn't buy it today is because it could come into the 10-day. See, it could come into the 10-day, and if you press the whole position here, the 10-day is 13%. And we don't want to be down 13% just on a normal reaction. So it's just really, it's very difficult to be able to buy an extended style like this when it's so much above the 10-day. You should definitely buy the stock at the 10-day if it comes into the 10-day. But notice here on this move up, it never even hit the 10-day, just about the whole move down, the whole move up. See that from 20, to 20 to 25, it never even hit the 10-day. So any down day, any down day, as long as the stock is still in that uptrend, I would buy a little bit. But I've got a 10% position in it personally. And I bought it the day of the move right there. And I think that's when we bought it for our clients too. But we didn't know if it was going to come into the 10-day, and right there we would add more, and it just hasn't come in. And then they did the secondary. So the best stocks don't give you an opportunity to get in. So this would be one of the top stocks, one of the top 5 stocks that we feel that are in the market, today. We actually bought this SYM. See how this SYM, we bought this here. And this is a company that's got they've got the Walmart warehouse deal. So they provide them with artificial intelligence robots, and they've got a $23 billion backlog that's signed. And they've got, and that's with the partnership with SoftBank. And we bought the stock right there. And unfortunately, it's come in. We haven't sold it, but if this stock reverses off the 21-day and turns up, then you can, it's going to be setting up. But that VRT could do that. You don't know who's going to work and you don't know which stocks can work and which stocks going to fail, but it's giving you an opportunity of the 21-day now. On a turn, this would be a pretty nice pullback by taking out the prior day's high, taking out today's high at 52.44, and then that high right there of the next day. That was 54.70. So if you see this stock reverse, and they've got great revenue numbers, great products, and they've got a terrific, huge backlog of business. And so that's why we're interested in that. Some IPOs, guys, this NXT, that's the earnings report. So we're sort of watching that in reverse today. And this is a solar company, a new IPO that's got, very strong financials. So, the key is to be watching, all these stocks and then watch for the reversal and, have your list comprised and just, have them on your screen so you can see, see when they turn and have alerts, on your screen as well to alert you that you're hitting the prices that you want to take a look at.
What do you think of TDW Tidewater?
Man, I heard this. The reason I love the stock. I missed the stock. I mean, I saw the stock like right here.
Mm-hmm.
I saw the stock move up to 52-week high. And remember, look, guys, what you want to do right now, you want to look at your new high list. The 52-week high list, and also your all-time high list. That should be your buy list right here, right now. They need to be in 52-week highs. You don't want the laggards. You want these types of stocks. And so I thought that I missed it. I did miss it, and where it got real tight, and then sort of like that VRT, and went higher. And then came in, they reported earnings today, and the CEO, and this stock was off like 5. And the CEO said in his earnings call is that this is the best business environment that the company has ever seen. And so that's why the stock reversed, and they had a great quarter. These are great numbers. And $2, $4, $6, $8 billion $800 million in sales with a market cap of only 3.2. And look at the numbers. Look at the numbers in 2023, $3.36, and then it's going to double next year. So this really is intriguing. And it's also gave you that shakeout. See, everybody that got shaken out, they got shaken out. So this went from the weak hands to the strong hands, and this got great action. So we're very interested in this stock. I think it looks fantastic.
David Ryan was talking about it this morning on IBD Live, and as he was speaking about, he had the 5-minute chart, and this thing was just totally recovering. It was like, he
look at that.
Yeah. So he was talking about it during that major dip, and then it was just coming back, and I picked some up just because I couldn't believe Like the recovery was so powerful, eh?
It's rare that you get recovery right there. And that's really the institutions that are stepping in there, and they're buyers. While it's going through it broke the 21 day and people are looking at that, they're selling it right there, thinking that it's going to be like a Palo Alto Networks or a Fortinet, and it's not. The smart money was buying right there. So, how would you handle something like this? I probably would initiate a position now, taking out the high, whatever, 65.79. Today's high, 65.75. If this stock came and made new highs, I probably would add a little bit. I would initiate a position small, and then I try to get larger, on some type of pullback, some type of like 2 to 3 day consolidation like this, some little hiccup in the market. But this stock does look fantastic to me as well.
Roy, in that regard of this stock looks like it had 5 days of short interest per Marcus Smith. And also I see a couple signs there of insider buying. So how you consider those characteristics in your trading decision?
Francisco, I didn't get your first criteria, but the second criteria was insider buying.
Yeah, and short interest.
Oh, and short interest.
Yeah, so maybe today's action was some short covering too, as it gaps down for the shorts and
let me
take
see.
profits.
Well, the short interest on this stock is, where is it?
On the top left, below the website.
Short interest, 4.6 days. And how much is it? So maybe five days, 4 million shares short. And it's, traded 2 million today. I think, 5 days isn't that much. That's a little bit of short interest. It's not that much. It's not like Celsius. I think Celsius had much more. But short interest, this is how you should use short interest. If the stock is making a 52-week high or making a run, you want it to have a lot of short interest. But if the stock's not at a 52-week high, say the stock has been selling off, say it's down 15% from its high, 15 or 20% high, then those guys are typically right. So it's very important that you weigh short interest accordingly based on the chart, based on whether or not the stock's trading at an all-time high or not. So the more short interest that you have and the stock's powering ahead, the better for you. But when the stock's making a new low, or when the stock's way off its high, those guys are typically right. They've got a really good handle fundamentally, and most likely they're going to be right. And insider buying, never look at insider buying. I've seen too many guys like this APP. I think it's this CEO for APP lost like $500 million in, it's either APP or it could have been ASAN. Yeah, from 140 all the way down to 14. And so, insider buying. So if you're sitting there looking at insider buying, this guy bought it all the way down and lost, a fortune. So I don't look at insider. I don't look at insider buying, nor do I look at insider selling, because a lot of CEOs, particularly when the stocks made a big move, they want to diversify. They want to buy that next, $5 million house. They want, they got to pay for their kids going to college. They've got to do some estate planning as well. So I don't really pay attention to, to insider buying. I haven't been able to see that that's given me a real edge over the last 30 years. This ANET's looking interesting. So this is the earnings report. They had a really good earnings report. And ANET is right in the thick of things in artificial intelligence. So in the artificial intelligence area, in the networking area, I think the four big players are ANET, SMCI, Palantir, and VRT. I think those are the big players. And then on the software side, you of course, you've got Microsoft, on the software side. But everyone's going to be implementing, AI. Everyone's implementing generative AI, and Microsoft's the one that's going to monetize it the easiest.
How about it's Extreme Networks? That's they're in the same industry group as ANET, I believe.
It's a small company, but see where I have the trend line drawn there? Like I had an alert right there. And 98 relative strength, you got fund sponsorship. It's a tiny company. Look, 4 billion. But let me see, what's the weekly look like? Yeah, look at this. There's the weekly. There's the monthly. So this stock's, it broke out of a 5-year base. It looks fantastic. This style looks fantastic, and the numbers look at the numbers. So they reported earnings were up 120%. This is exactly how you want your stocks to react after the earnings. You want them to gap up to a new high, not give much money back, not give much performance back, and then just sit there and then make the next move higher. I mean, great action. Earnings projected to be up 33% next year. And, in the network infrastructure area. So yeah, you're in the same group as ANET and SMCI and all those stocks. It looks fantastic.
Roy, could we look at CHGG? CHGG?
This stock had very poor. It's the stock, very poor reaction to the earnings. Stock was up 20 to 30% today, and they sold right into it because of the overhead. And it was one of those stocks that it was up on big volume, and they just sold right into it. But you just have so much overhead there. And there was this stock broke from 18 to 8 because of a competitor. I think
it's because ChatGPT is going to run it out of business.
Oh yeah. Okay, that's right. Yeah, that's right. That's what it was.
Right, but the management was very positive on the call today. They think AI could be actually helpful to them. It could be a tailwind, not a headwind. The idea is, to run AI, you need to have content, right? And they have very good content. They know what the education business is. They know what students want. They know what kind of test you have. So they think they can actually leverage ChatGPT or a scale AI to give a better conversational experience to their students.
Yeah, the problem is
nice.
The problem is earnings are going to be down 15% this year and only up 5% next year. And the relative strength is only 10. That means it's underperforming 90% of all stocks in the database. And you've got this huge overhead. Why would you buy this when you can buy a company that's growing 50 or 100%, per year, per quarter even? It's just not it's not your best way of utilizing your capital. Regardless of the story, every CEO they're going to be lauding, their business. They're going to be, they'll be telling you how great their business is, but until it reacts positively, and the stock's under a declining 200-day moving average as well. I would never buy a stock below the 200-day moving average as well. That would be a huge violation to just any legitimate claims that the stock should be bought.
All right.
Yeah, go ahead.
Hey, Roy, do you have any opinion on Fastly, FSLY?
Hey, Michael, how are you?
Good and getting better. How are you?
I'm doing likewise. This stock's been left for dead. It was a big winner in 2020 for us 3 years ago. But it's, you've got this nice little base that's going sideways for 5 months. They've reported earnings. It's out of the way. And relative strength is 98. See, this is, this is what's different from, buying a stock that's been in a stage 4 decline. Now it's in a stage 2 upturn, just turning the corner, and the earnings are out of the way, and you traded the largest volume, since it's been in in a stage 1 base. So this is looking, this is looking certainly better. And it's, you might look at something like this as being like a hidden gem. So it's got great, very good action, very positive, turning the corner. And, it's a pretty small company as well, 2.6 billion. The earnings aren't there, but, they've got some revenue growth, and the stock is acting, the stock's acting better.
Well, I just drew a trend line. I'm going to stay on the right side of it.
Yeah. Yep. These home builders there's Lennar. These home builders continue to act well. PHM, there's Pulte. GRBK, Green Brick Partners. This is one of the first ones that moved off the earnings report. So this stock's going sideways for 3 months, and they just reported, I guess, a couple of days ago.
A lot of air conditioning companies are doing well, like Fix is one. Can't remember, there's another one. Under the symbol.
Comfort Systems, let me see. Industry and sector. Few stocks in the industry group. There's this AAON, that's this AA in Modane, AAON. That's been doing well. That MOD, oops. Yeah, see the group, this MOD's been doing well. There's been some rotation into these segments.
LMB is another one.
LMD?
LM as in Mary, B.
Yeah.
You go on the week here, it's pretty, it's just up and to the right, that thing.
Yeah, look at that. Wow. It looks just fantastic.
Not a very liquid stock though. It's pretty.
Yep. But it's in an excellent group, ranked number 9.
Roy, can you look at Axon, AXON, reported today?
This stock, it's up 17 after market. And it just shows you, it shows you the hit and miss market. I thought that this stock was setting up great, and we actually carried this stock into the number and had to immediately sell it on, when it gapped down. And so this is Taser, this is Taser. And, they had really good numbers, the quarters before, 52%, 96%. And the stock was near an all-time high, in May. And that's when, mid-May is when most growth stocks started to move. And then this is one that was, a minefield. We've had some of these that have been gold mines and others minefields, and now the stock is now moving back over the 50-day probably on, and the 200-day on the number 190. Yeah, so right there. So, you know, when these stocks go through transitions like this, when they finally turn back up, you know, you have to put the, you have to respect the last quarter where earnings were up 152%. I haven't read the number, I read the report, but Melly did the same thing as well. So, you know, this stock was unbuyable for the last 13 weeks until like today on that, tomorrow rather, on the earnings report. And you just need to see if they'll sell it, if they'll buy it on the number, or if they'll sell it on the number. And you just don't know. But this is one, I wrote it down after market as well to look at it tomorrow. And see, here's Melly. And we got kicked out of Melly, and we tried this a couple of times, but Melly, this is Mercado Libre. You know, it's had some great quarters, up earnings up 33%, 457%, 200%. This quarter that just came in was 112%. And look at it at the 200 days just a month ago. So came unglued totally. And we own the stock and we sold it on the bounce back to the 200-day, like right there. And we sold it on the move up, and then it consolidated, and then it broke out on the earnings report. So, and you know, this stock, it goes to all-time high territory right here at 1365. And you know, a 52-week high right there. Not far from an all-time high either. An all-time high is right there. But this stock, I think, should definitely be on your list as well, based on the earnings report. I mean, this is a huge company that had mind-blowing numbers. There's a lot to, you know, there's definitely a lot to like. Look at the mutual funds that are in it, the A+ funds. Look at all these funds that are in this stock. That's what got me interested in it before. And it wasn't buyable. If you were sitting there watching it, you know, like you could have bought it right there on the open. And the stock was showing up. You had gotten shaken out like right before it closed bad the day before. So everybody that got shaken out, you could have bought it right above the 200-day, but I did not. It was too late to the party, and then that's kind of what's going on subsequently. But you broke the downtrend line on the earnings report, the great earnings report where they beat the number, and now your next move is to be actionable over 1365, see where this trend line is. I mean, almost there. So more than likely, if you take out 1365, it's going to lead until the next earnings report. You know, you're going to be testing this probably the 1600 area. You know, if you get a nice 12-week run on it.
Roy, can you check out Zillow on the weekly chart, preferably? It doesn't have the best fundamentals, but the chart on the weekly has a lot of accumulation.
Yeah, it does. Yeah, it does. And you know, these stocks that are left for dead, I never understood why Zillow, with their market share leadership, how they had all the data and everybody uses Zillow. How could they not monetize that? And I never knew. Look, even the last 3 quarters were poor. And you know, this is an earnings per share of 3%, not exactly blowing the doors off, but you know, the stock has bottomed. You know, it's bottomed. It's been, you know, it's under accumulation. You can see the weekly bars of blue, but you know, it's a slow mover, but sometimes slow, you know, you can take a look, slow's good. I mean, this stock's had a nice move this year.
It's acting better than Redfin.
Yeah, or DFN. Yeah. So, I like it I definitely like the action here, and it's in an uptrend, and it's, I think that's it's at a 52-week high. So maybe they're turning the corner. Oh, I wanted to pull up ONON. They report in a week, and we're long this stock. So, great earnings projections this year and next year. Great numbers, great earnings numbers, great revenue numbers, and you'll want to see the stock act like Celsius coming off the earnings report. But it also has a number of things that you're looking for in terms of mutual fund ownership, the funds that are involved in it, the relative strength, the earnings power. It's a great, they've got a great selection of shoes that are very fashionable and are widely known. Okay.
Any take on United Rental?
Oh yeah, URI. I passed by one of these Saturday, and I was checking out their yard, and they had all their tractors there and all the power equipment that you can lease and rent and so forth. Really good action. Notice how this is what makes this market so challenging. You can see where the stock had a nice move after earnings, a quarter ago. It looked great, and then it just rolled over. The stock rode over, then they came out with the bad quarter, and then it's just repaired the damage as the stocks had a good quarter. It's gone from a good quarter to a bad quarter, now back to a good quarter again. So it's been definitely tough to trade, but you can see you did have an early entry here, way back here, when the averages were turning up and you had the crossovers and so forth, But, it's a good chart. This is a legitimate cup and handle right here. The handles, the handle is, it got, kind of crazy right there at the bottom during where they sold it off, but it snapped back. It's definitely a legitimate pattern. It looks healthy. Oh, Shake Shack had a good report. And so Shake Shack reported, earnings up 900%, broke the downtrend line, broke it, and it's been consolidating for a couple of days. This is really the kind of action that you want to see. You don't want to see these stocks that are just getting hammered on the earnings report. They don't necessarily have to go up, but just don't go down. And they can be the next, those are the ones that can be the next leaders. So good quarter. And this is buyable, over 80.58, technically. And it was buyable over that downtrend line right there 2 days ago. So it was buyable following through on the shakeout. And, it's, a stock like this, if you're watching this stock closely, you could buy it at 80.44. Yeah, it's so close to 80.60, just at 80.60 on the breakout.
Roy?
Yes.
What are your thoughts on stocks like that where it's kind of going against the crowd, the rest of the group? So like Chipotle was hot, so was Wingstop, and what was the other, Texas Roadhouse, and then they all kind of fell apart. Is this just a laggard catching up, or is it uniquely different? Would you trade if the rest of the group is not acting as well?
Well, that's a great question, Dana. That's that's what you have to ask yourself. I mean, CMG was the leader, then it had a very bad response to the quarter. They had Wingstop that I've been tracking for months.
Yeah.
That really, it really peaked on that last earnings, and it hasn't recovered yet. And then you have this one, you have that KRUS that had a good quarter.
Oh yeah, you guys talked about that last month. Yeah.
Yeah, so that one had a good quarter, And it's hard to, and the stock went up. Now it's pulled back to the 50-day. I love the restaurant. And then you have Kava, right? You've got Kava as well. So this Kava's come in 4 days. I mean, we're looking at this because, we love the dining experience. You've probably been there, haven't you, Dana?
Yep.
And what did you think?
I think it's great. I think it's like Chipotle was years ago. I think it's really good. First Watch is one of those as well, where good experience and they look like they're expanding. And you would think with services doing better than goods, that space would be good, but it's always confusing. If one's doing well, is it the laggard? Is it the leader? Do you just not mess around with it because there are other places to invest?
There's no right answer. There's just no right answer. Again, this is one of those where you might get the biggest winning stock while the rest of them roll over. So what's the symbol on First Watch? Do you recall?
Yeah, it's FWRG, I think, First Watch Restaurant. Yeah. It looks all right.
Yeah, it looks great. I think do they have one of these in Waverly?
Yeah.
They do. Okay. I haven't
and they have
been.
them in most major cities. You'll see them. They're breakfast only.
Oh yeah, it's on the left. I know where it is. It's over there. Left-hand side. I mean, looks pretty good. You have so many of these, but some are performing poorly. There's Portillo's, and then you've got others like First Watch and Kava and so forth. You got the haves and have-nots, I guess.
Yeah, Chipotle looked great. That was attractive, but then it just fell apart. And I'm still watching JFrog.
I think I think Chipotle, it was so overowned, probably.
Roy, can we look at the long-term leader in restaurant or the pizza chain Domino's?
And Domino's long-term. I don't know if I could have handled having this. And the only stock that I owned coming out of the 2008 bear market, you probably would have done pretty well if you had your whole account there for the next 15 years. That's probably, that probably would have, in retrospect, would have worked. This is one of those long-term leaders, and they do a very good job in terms of changing their menu, and they do pretty well. So obviously the stock moved up on some kind of number, not a number, but some kind of announcement, and then the stock's going sideways. Relative strength of 85. It's it's in a stage 2 uptrend. But you've got overhead clearly. You have overhead clearly up here, and I'm kind of ambivalent on it. I think I would prefer some of the later, some of the newest merchandise like that, or what we were just talking about, Kava. But you've got earnings due in 7 days in this Kava, but and you don't have a proper base. You can see I had a trend line drawn down there at 45, and then it's just so wild and whippy. But I do like the concept here. I like their restaurant chain.
Hey Roy, how's it going?
Hey Joseph.
Hey, what do you think about Roku holding the 10-day?
I think it's a buy here. It had a good response to the number. It's come in. Now, if it takes out these lows, if it doesn't hold the 10-day, I would definitely punt it. But, I think, it's one of these, if you buy it while it's going up, not trying to guess right here, if you take out that high, yesterday's high of 88.56, I think that's it's better to buy it right there, Joseph, I think, than buy it right here, because it could, if it goes to the 21-day, it would have failed.
Yeah, actually, I have a position in it from the earnings gap. I bought it at like 78.50 on that earnings day on the gap up.
Yes.
And I haven't sold it yet because it hasn't broke the 10-day, but like once it closes below the 10-day, I'm probably out of there.
That was a great, that was a fantastic buy. And that's again, one of those 10-300 days, right?
Exactly, yeah.
And, ideally you would want it to continue to go and not come back like this, just like that SYM came back into support. You don't want that to happen ideally, but some of these drift back, they drift back and then they turn. But what's so nice is you got a profit to work with.
Yeah, exactly. And I'll give you one more. I can't give you financial advice on this one because this is the company I work for in real life, but XPO.
Yeah, looks great. This transportation area, we have a client that works for them as well. And it served them well, over the last couple of months. This transportation area like SAIA on that breakouts worked. Yellow went under, went into bankruptcy. And so, this is kind of crazy too, where people buy stock going into bankruptcy, it moves up to 5. Bankruptcy means you're not going to have anything. The equity is going to zero. And this is the easiest way of going broke as well, as buying a bankrupt company that you think
noticing that trend
and
too.
it goes to zero.
Yeah, like they did that with Hertz a couple years back. I'm like, what's up with everyone pumping these bankrupt companies?
Yeah. Let me see what else. ANET, Celsius, DraftKings, Google.
You guys still own Uber?
Yeah, we still have Uber, UBER. So we're in this Uber, and I think it's a buy right here coming into the 50-day. And they had, I thought the conference call went great from the CEO. And this stock is just, I think it's one of these that have that characteristics where the IPO, it's turned the corner and it's going to come up here to the digestion phase. But yeah, we still have it and we like it. I think it's a buy coming in here to the 50-day. And we bought this stock somewhere after earnings, somewhere back in here, I think.
What about Dropbox? Any thoughts on Dropbox?
On who?
Dropbox.
Oh yeah. So this is this actually hit the screens. So earnings a couple of days ago. There's Dropbox, $10 billion company doing a couple of billion. Relative strength 89. What's the overhead in the weekly and the monthly? So it's sort of right there at resistance now. And looks similar to Uber a little bit, does it not, on the monthly? See that there's Uber and DBX looks pretty similar. Definitely looks like a turnaround situation. Quarter was good. Obviously, they accelerated, and 700 million users. That's a lot. And it came into the 50-day turn. Now, what you want to see, this stock just just get tight. That's really what you want to see. You want to see it get tight, and then take out, yesterday's high and that high right there to add to it if you already own it, or to initiate a position, with it. So not bad. It's just, it's snap. What's nice is, see, this is what's nice. So in 1, 2, 3 days, it's recovered the entire drop. See right there? The drop that it took, 2 weeks, you got it all the way back in 2 days. And that was consistent with the earnings. Yeah.
And that on high volume.
Yes. And excellent volume right there. So that's a nuance. See, these are like just little nuances when that give you little clues. And, this looks definitely interesting as well.
Roy, what about Twilio?
I saw it as an aftermarket. So
yeah,
I thought that you've had a couple of these, and we had a position in Snowflake that we got kicked out of that went the wrong way. And another one, and the Twilio's going the right way here. They reported earnings. I haven't read the report. You do have a lot of overhead, but if you can get through this, it's down so much. See, from 457 to 60, it's hard to see, to decipher, but it was at the 200-day. The quarter's out. The quarter was obviously decent. It'll just dictate on if they sell it or they buy it. I haven't read any reports after the market from Wall Street, but I thought this stock was really cheap. See, $4 billion in revenues, and it's only $11 billion market cap. I'm just not sure of what's going on with their, with enterprise spending and their build out and their client base and things like that. So, some of these will come back to life. Let me see what, there was another one, Twilio and who was it? Went the other way. RNG, yeah. See, RNG was similar, and look at this. See, RNG dropped 18% today. And look at the numbers on RNG. See, first of all, it's down from $450 to $25.
Wow.
Down 450 to 25. And then earnings were going to be up 62% this year and 15% next year. And they're doing $2 billion in sales with a $3 billion market cap. Man, this thing looked like extremely cheap, and yet the stock's down 18% today on the number. So that's the danger, in buying. You don't know which one's going to work. I certainly thought Snowflake was. I certainly thought this was going to work, and then from down here. And then the Datadog news hit, and impacted the whole group. But this stock moved up on the artificial intelligence. Looked like it was going to break out at 194, and then it just rolled over.
So some of these companies, Snowflake, Datadog, Twilio, their pricing is based on consumption. So more you consume, more you pay. And it's hurting all of them right now because enterprises want to control their spending. So they're watching it very, very carefully. They're trying to control their spend, and it's really hurting all of these companies. But once things improve, I think that would be a good time to get into all of them.
Mm-hmm. Thank you.
Roy, could you check out Joby? It's an IPO from late 2020. And it's an air taxi, which I really like. I think that's the technology that you know, these rich people fly into an airport and they get in an air taxi and they fly over the roads and get to their destination quickly. And they're talking about like a $3 per mile rate, and maybe going down. They've got their FAA, 2/3 of their approvals are done. And they also have a testing prototype right now. From a, you know, what I call a paradigm shift from Ubers to something else. I think this could be a technology going forward that would be great.
Yeah, you have, thank you. Was that Mark? Thank you, Mark. You've got two companies that are competitors of theirs, BLDE and also ACHR. And both of these, Joby and I know ACHR, they both have relationships with like the US Air Force and the Department of Defense. And also, I think Joby has a relationship with Delta Airlines, if I'm not mistaken. And because it certainly makes a lot of sense, you know, going from, you know, for flying rich people from, you know, the Galleria in Houston to downtown, and, you know, from JFK Airport to Manhattan and so forth. And so, you know, also, you know, Kathy Woods, for whatever it's worth, she owns this in the ARP fund. And, you know, you had tremendous volume there. You see that 94 million shares. And where the stock had this powerful move, and then it's come all the way back. They reported earnings. The problem with the stock is it doesn't have any earnings power yet, or revenue power. But, you know, it's got you know, I'm always looking for innovative technologies that can change the way we live, work, and play. And this certainly fits the bill. So it makes all the sense in the world. What they're going through right now is they're going through the FAA process where they're going to have, the FAA is going to have standards for all this type of aircraft. And so that's sort of what's going on. So this might be you know, an early entrance to a new category that, just like we didn't have Uber and Lyft, you know, 5 years ago. So it's definitely something to watch. They don't have any numbers yet, but the aircraft looks great. And you know, along with the ACHR, see this ACHR, that got my attention right there. And I forget what the news was on this, but, you know, some kind of positive development. But, you know, it's a, you know, relatively new company, no numbers. But when you look at both of these companies, you look at the prototypes, man, the design looks terrific. And you can play their videos to watch, you know, watch the aircraft land and take off and so forth. It's very interesting, but it's just it's a new industry that's not making money. So, you know, Wall Street's not going to get involved until they're really making money, but it's one of these IPOs that definitely off the bottom. And I definitely like the category. It definitely should be watched.
And if you look at, you know, their funds, the amount of funds that are getting into them is growing. So
you can some of these stocks are then big. This could be a huge stock. You know, this stock could go from 8 to 80. Anything can happen once the stock gets to new highs. And, you know, it's going to have to do with deliveries of the aircraft. And, you know, what's nice about it is, since they don't have any sales yet, it's going to be 100% a year for 2 years, right? So you're going to have triple-digit sales growth for multiple years, just like Tesla, when Tesla came out. You know, Tesla grew, you know, 100 to 200%. for 3 years because they had no, you had 0 vehicles to compare it to. So this is really a support here. So this is, it would be very interesting from a speculative standpoint to, buy it down here and sell it, breaking that low of 2 days ago, 3 days ago.
Right. Okay.
Yeah. So I'm watching it too. But I'm watching it too. It's definitely got my attention. The other one was BLDE. So you have 3, and look at this, it's a $4 stock. I would never buy a $4 stock, but you've got a number of stocks in the group. So you got 3, it's Joby and this it's ACHR that are the leaders for sure.
Okay. Thank you.
Look at Jacobs Engineering. They had a great report today. I see it, it's just Jay. I see them tied into all this infrastructure spending and the like. So I like it.
Okay.
It had quite a jump today. So I'm wondering if you were interested in it fundamentally, where would your entry be, given that you're not in yet?
I look at the weekly. See, it broke out this week. I mean, this is a pretty convincing. I definitely like what you're thinking right there. There's this, if you're watching it from the trend line perspective, and maximum alerts have been, got to cut some of my alerts. I'd like to see it, and it's gapping up $1.35, up 5. Some kind of consolidation, Carl. It's so difficult. I mean, it's just turning the corner. Heavy construction, it's that PWR is in that group. That looks pretty good too. I would just watch to see if it consolidates, if it comes back to the 10-day. And no, it's very extended above the 10-day right now, 5%, but it could have a couple of day pullback and then turn, I would not chase it, but it could, you don't have a proper base, but if you like it, I just let it come in. I mean, it'd have to be, a down day, and I would just incrementally buy it, like 1%.
That's what I was thinking. That's what I was thinking is that, I could just take, like, say, a 1% position in it, and then, just see how that goes and just stop out at my risk.
Yeah. Yeah.
And what does IBD say about it fundamentally? Do they have anything to say about it?
The earnings per share ranks 84. That's fine. Normally the biggest winners start with at least an 85 earnings per share rank. And what IBD is going to say is there's a screen that shows up on, it's called the week in review. And all the screens that I've mentioned tonight, you're going to get like the true market leaders, the stocks that can double and triple over time. There's going to be a handful of them, but Bill found through his research that the stocks had the biggest stocks had at least an earnings per share rank of 85 and a relative strength rank of 85 before they took off. And it was stocks that were within 15% of their 52-week high. So it doesn't hit the criteria yet. See, it's 77. So it's not going to be on any list. And you want it to, you want the stocks that are on the list that the institutions are buying, right? That's what Wall Street's buying. That's what everybody else is buying. They're the ones that screen the best, that have the best fundamentals. Quite doesn't have it yet, but maybe one more quarter it tightens up, and in the next quarter's better, and then it's got a higher relative strength and so forth. But it's definitely acting. It's a slow mover. it's not a fast horse, but you don't necessarily have to have all thoroughbreds, do you?
No, and thanks for that advice.
There's this PWR, it's been on my screen forever. So this is one that's similar with an 88 earnings per share rank, but it's got a 92 relative strength. See, this is performing better than the one with the 77 relative strength. But you had MTZ that blew up yesterday, 2 days ago. And this MTZ, see, was in new high territory, then they reported. And a lot of people got caught on the wrong side of this one. So this was a very disappointing quarter in that, in that group. So is it going to affect Jacobs Solutions and Quanta? Time will tell.
Might just give us that entry you want.
That's true. Yep.
Thank you.
You're welcome.
Any thoughts on Pure Storage? Pure Storage?
Pretty powerful. Pretty powerful chart. It moved up on the earnings, and 94 relative strength, 85 earnings per share rank. I like it here. Its earnings are in 15 days, but it's coming back to the 50-day. And it's going to need that earnings report to project, to get the stock into new high territory. I'm definitely watching it, and look at it on the weekly. So look like, look at that on the monthly. See, what I like about it, it's in all-time high territory, which is, this is where you don't know who's going to be the next SMCI, but let me show you this. This is the monthly where it went to all-time high territory, right? Let's take a look at SMCI. Look at when it went to all-time high territory at 40 to 350. And Pure Storage is going into all-time high territory. Not that, of course, it would duplicate this, but stocks that are the most powerful are the ones that go into all-time high territory. And, you're going to need a good earnings report, but it's there, right? It's there. This could be a big leader. But you got, you'll know in the next 15 days when they report. Definitely. I'm sure you're watching it or own it. It hasn't done anything wrong yet.
Thanks.
You're welcome. ESTG.
Right. Go ahead.
Pardon me?
Oh, no, I was going to say, I'm really curious how this Celsius gap is going to go tomorrow, because I already know it's going to probably be a 10-300, but just wondering if they're going to buy it up or if they're going to fade it. That's going to give me a big clue of what's
it's so I'm going to tonight, later on, I'm going to go through like the most recent ones that gapped and faded, and also the gaps that worked. Because what didn't I buy that worked? Some of these in the midst of a market that's under pressure, they really work despite the market being
exactly like a VRT,
Yeah.
I'm not in this one, and it's driving me crazy that I'm not in it. I gotta wait for a pullback.
It's easy to press the button and get in there.
And I feel like on the indexes, I don't use Bollinger Bands a lot or at all. I know this on the NASDAQ, we're like at the lower end of the Bollinger Band. And it feels like since August 1st, every day there's been more stocks down than up, at least like 4%.
Yes.
So I kind of feel like we're due for a bounce. It's just a matter of how the bounce is, I guess.
I'm looking, let me pull something up if I can update my data master list. See if I can update this and I'll point something out to you guys. Okay, let me check on something. It's not what I wanted. Let me pull this up. Are you looking? There's a particular chart that I've got the NASDAQ up. It's on a chart called AIQ. Are you guys seeing this?
Yeah, we see it.
Okay, so take a look at this. So, and let me get. This is very similar to your Bollinger Bands. This is AIQ's way of looking at it similarly. It's like within 2 to 3 standard deviations of the mean, Joseph. And you see how you have the top. This is very similar to a Bollinger Band. And then you have the bottom of the bands. And so we're right down here at the bottom, as you surmised, as you mentioned, right?
Yeah.
And what I want to point out is take a look at, see, we're at a cell on the MACD. And so, I'm looking to see if we get a little bit more oversold, like on the stochastics, where you get down here to this level here below 20. And, and look see how you broke the 50-day right back here in March, where it looked ugly. That's the day of the banking crisis right there, where it just looked nasty there, that last little leg down. So it's going to be interesting to see if we can get down to the 20 area or not. But I'm looking at things like the price phase and the MACD. See, I want to see this MACD turn. See the way that it turned here, and you got your buy signal.
Yeah.
So I'm look at how this buy signal worked here in January. You got the buy signal, and then you got the move up. So we could go through some turbulence until these indexes, bottom and then turn up. Now, see, I'll also point out, see this 10-day, the green line's not below the 21-day yet. So it's going to snap back, or there's the risk is that we go through it and you get a crossover to the downside, the way you got a crossover way over here. And you had another couple of weeks, a few more weeks before you finally bottomed. And notice when you got the crossover way back here in December, it took you like 4 weeks. So if we cross over, it may take 2 to 4 weeks to finally just stop going down and go sideways. But I'm watching this MACD to see for it to give me a buy signal and turn. And also, this is one component of the price phase. This is called one component of the MACD. This is called the price phase. I want to see this price phase go from a downturn to an upturn. See if these prior moves in the past where it's down and then it finally turned up, that signified the correction was over. And so I'm looking for signals like that. And I think we could have some more downside before it turns back up. So, this SKSD still in a sell, it went into a sell mode over the last month. So that's in conjunction with this new, high list shrinking and the new low list expanding. And so we just it might take us a little bit more time. I don't think we're quite there from an oversold level yet.
It makes
So that's
complete
what, that's something that I'm watching closely.
That's great stuff. Thanks for showing us that.
Roy, can we look at IoT?
Yeah, what's the symbol?
IoT is in our list. Yep.
We sold half of it today. And we just had to, you know, we a good earnings report, it made a new high. And just for, I mean, below the 50-day for a couple of days, and we were not exactly sure where we bought it, but we just had to, we felt like we had to scale out of it today. But we do like it. We like the idea. I mean, this could be a shakeout. We like the idea. See this turbulence zone where it almost made a 52-week high, and then it's come in from 20%. I would buy the stock back if it'll turn. I just don't know. Yeah, I don't know if it's going to turn or where it will turn. But like technically, the stock's weak below the 50-day. You've got to cross over to the downside. We took probably at least a 10% loss on it. And if it gets back, and it's funny how you can always redraw these, trend lines, but see, now you have a new actionable trend line here, breaking this downtrend line. So, if it'll turn and it gets back above the 50-day, that'd be a moving, average buy signal from under the 50-day to back above the 50-day. It just needs to strengthen up and hold here. The way these stocks have acted, you don't know if it's going to go to 20, or if that's the low. That's the art of trying to handle these. But we like the stock a lot, and we were forced to sell it today.
Great.
We could certainly buy it back. What's good to know is when you get shakeouts like this, when it goes over 30 the next time, it's gonna be the real deal. It's gonna go from 30 to 60. So don't stop watching it. If you're watching it and you're not watching it because of the action the last couple of days, I mean, it's gonna be right on our monitor, but it's got to perform better.
Got it. Thank you. That was very helpful.
You're welcome.
Hey, Roy, when you want to, I'd say today when you had to sell, now, do you just have a stop in that you don't change, or do you wait till the end of the day to consider it and then pull the trigger then?
There's so many of these whipsaws where they go down, just new, like we didn't sell that MDB today because there's a lot, because first of all, it had nothing to do with MDB. It had to do with another company. And that may or may not impact MDB. That's the Datadog quarter. So we never put in stops because, we might have 100,000 shares. We don't want them to hit at the market, where the market maker can see it. So I typically, if I'm away from personally, for my personal account, if I'm away from the desk, I always have stops in personally. But Wes and I are manning the desk all the time. So we have mental stops, and then if we're forced to sell it, then we're going to sell it. But a lot of times we can't sell it, just like you're selling 1,000 shares. We have to work our way out of it. And so that's the difference between, having big size and making it more difficult. Like this was hard to get out of today. So the average daily volume was 4 million shares, and it was 1 million shares. I only traded 1 million shares when we started selling it. But this is off the low. See, it did close off the low, which is good. And I actually didn't check with Wes to see if we're out of it all, but we sold it into that, the gap down. Where's it going? We don't know where the low is.
Right. Yeah, so your discussion on size there, of course, that doesn't apply to us, and it's a totally different issue. Got it. Thank you.
Yeah, for something like this, you could buy, you could buy 10,000 shares and not move it, but if you buy or selling 100 or 200,000 shares, you're going to affect it. You can't affect it. If you have a market order too, that market makers, people could step away and then, and they could fill you like 2 points below where the market is.
Yeah, I did not think that the market makers could actually see your stops. I thought your whatever your broker did not actually send it till it was hit your stop.
They see it on the level 2 quotes. They see it.
Really? Okay, I thought not. Okay.
Oh yeah, they definitely see it. In fact, a lot of the high frequency traders utilize this information to manipulate stocks.
Well, I thought that all they saw was limit orders, not stops.
That's why a lot of people they put in orders through dark pools. That's another mechanism where you don't even know who you're getting who you're selling the stock to or who you're buying it from. But those dark pools that size, I don't think is registered on the exchange either. So a lot of people avoid showing their hand by using dark pools to execute their orders.
Yeah, thanks.
Not a lot of people. A very small group of people, really.
Hey, Roy, is Shockwave something we should look at?
I was just looking at how
been a head scratcher.
It certainly has. So the quarter apparently wasn't great, and there's the move down on the quarter. And we sold this stock 4 to 6 weeks ago because it wasn't acting right. And then, another one, the same kind, they had great numbers, but look at the slowdown in the numbers, Mike, from 900%, 230 to 164 to only 12%. See, the market got wind of that, obviously, in the last, month, that there's going to be a slowdown in their numbers. And, you don't want to see a slowdown. You need numbers like Celsius. You need accelerating numbers. You need numbers like NVIDIA, accelerating numbers. INSP in that, was at new high territory, and look at what's happened there in the last month.
Hey, Roy.
Wow.
Same kind of thing. Yeah.
Yeah, Roy, I have a question for you on the previous stock, Shockwave.
Yeah.
You don't have to disclose it, but if you got out in this one, at what criteria you used to get out?
Probably taking a loss at some point, like probably 5 to 8%, probably.
No. I mean, what criteria did you use to get out when the average fall below your, say, 50-day fall below something the other, or what criteria did you use to get out?
It could have been. It could have been a stop because of my loss, or it could have been a stop. Like we could have sold it. Like when something breaks the 50, we don't. I don't necessarily sell it the first day. I give it one more day to see if it'll recover. And I'm guessing we sold right there.
I see. So it's really 50 days the trigger line.
Yeah, if it's it's not always a sell, but you don't want it to. First of all, you don't want it to live below. If you didn't sell it, you could have sold on the bounce. Because it's not acting right. Like I think we actually sold day 2, right? That's what I think. And then it bounced, then it came down, and see if you didn't imagine how you felt if this day where it closed at the absolute bottom, then it rallied 3 days, and then it rolled over. And just to show you, how this, how this works when you get these stocks that were near all-time highs that roll over. So we own this stock. We've talked about this stock, Lantheus, for a long time. And we bought this stock, and I can't tell you where we bought it, but I mean, we're in this stock, maybe in here, maybe, let me get this, maybe in here, maybe. And then it broke down and rallied back up to the 200-day. Or maybe we actually bought it on the pullback, but I think we sold it when it bounced back up to the 50-day. I can draw that. Right here anyway, see where it bounced from this 80 all the way to 90 area, and then it rolled. And we didn't know that it was going to roll over, but it was a really good sell because technically it wasn't doing what you wanted it to do. Now it was below the 50-day, rallied back up to the 50-day sideways, and then we sold it. So that was a good sell, and just based on the technicals. And and we did the very same thing with Melly and sold it right there. And then it followed through. You just don't, you're always trying to play the highest probability based on the chart pattern. And below the 50-day is a lower probability of the trade working, of the investment working.
I think I saw Stan Weinstein say in a recent video he doesn't even want a stock below the 50-day.
He doesn't what, Joseph?
Like he doesn't even, like, if the stock breaks below the 50-day, he doesn't want anything to do with it.
Yeah. I think there's a lot. Look, there's a lot of things that you can do as an individual investor that you can't do running money and being an institution. It's very, that's why if it's your personal account, you can hit the button and go to cash, like boom. You could easily, with the, a $5 million account, you can easily do that. $1 million account, $5 million account, you can go to cash by hitting the button. But you can't once you get up there to like 50 million, 100 million, 200 million and higher. You just can't hit the button when the market has a bad day. And you can't sell everything on one bad day because it just might be a bad day. But you can certainly do that individually. You don't have those encumbrances that institutions have. So you can be more flexible. You can be more flexible and more quicker, if you will.
I saw I think he's at the IBD meetup coming up. John, I forget his name, John P, begins with it's a long last name, but he did a video on YouTube showing how the institutions will accumulate and distribute like at a top. And I thought that was super interesting how they, they'll kind of put the price higher so they can sell it into you and distribute it. And then, the topping process and all of that. That was super interesting.
Yeah, see, that's what makes it CNR. See, people are going to be selling this Celsius. It's up 15%. Whether or not you just don't, you're going to have people that are selling some here on the open, but you just need to see, well, how is the supply versus the demand over the whole day? And that's what we don't know. We don't know if, demand is going to overwhelm supply, or supply is going to overwhelm demand over the course of the day. You don't know that. But that's, you certainly don't want the stock to take out, to fill in the gap. And, ideally, it's showing up 15. Ideally, you could buy the stock, the open tomorrow at 165, and it goes to 170 to 175 during the day, and then you put your stop at 165. That's the ideal. So it's up 15, but some of these stocks go up 20 to 30%. You know, when you get a powerful earnings move right here, and everybody's going to have to be raising their numbers. And that's what's, you know, that's typically what happens. But, you know, taking out 157, I said that I was going to press this. Well, you see where I have the trend line. So I was going to press it, taking out 150. Well, it's already at 165. I was going to press it, taking out 157. It's above that. So you got to give it at least the first 15 minutes, I think. But normally the opening price that is a great price. You know, if it's on the ones that work, the powerful ones that work, the opening price many times is the low price.
Yeah,
let me see.
When the open price is the low price, the probability of it following through on that 15-minute is pretty high. I've noticed that.
Let me put opening price.
Actually, a matter of fact, Celsius last earnings report, the opening price was pretty much the low, and I know that because I bought it, but I didn't hold it because it came.
Oh, really?
Well, I held it until it came back all the way down to the 21-day, like weeks later or whatever.
Yeah, I was looking. I wanted to see like right there. See, this is. I don't like it. Well, I can
think on Market Smith, it doesn't. You know, like. I guess, yeah, on here it'll show it. Perfect.
Okay, so let's take a look. So the opening price was 118. See, look at this. Say, perfect example. So the stock was up. Stock was up $12.79. So it was up like 14% or so. And the opening price was your low price. See right there. Opening price 118, then it went to 134. You know, just the way that RELY went up 20% from 20 to 25. So that's what you have to contend with. That's the, you know, and it also went, you know, to a 52-week high, you know, on the number. And then it came back. Remember what I said, you never want these stocks to come back and undercut the breakout day. See where Celsius it came to the 21-day, but it did not undercut the breakout day.
Yeah.
That's crucial.
That 21 where it touched, that's the day I got, well, because I had moved my stop up to break even. I didn't get the open price. I got like 120 something, whatever. And it came in and I didn't want my whole gain to turn to a loss. So I'm like, oh, I'm just gonna cut it. But that was the low. I sold the low. I couldn't believe it.
Yeah. It's
it happens sometimes.
Absolutely it happens. So it's so it's, you know, it's hard to decide if you're going to sell into it or, you know, let it have a natural reaction. You know, that's just a natural reaction. You know, if it would have held there at the 10-day, you wouldn't have been shaken out at all. You know, you would not have sold there. You wouldn't have sold there. But like there, it starts to get sort of hairy, you know, where it's breaking the 10-day. And it was close. It was close to the bottom, you know, and then it turned, and there's the reversal day where you could have actually bought it back.
Yeah, I should have. I get so stubborn. I'm like, oh, I just can't believe it's happening. I'm like, really? And I just didn't buy it back.
And then this day, see the big day where it's up 8, and now it's too late to buy, right? So, you know, you should have, you know, if you're sitting there looking at it, you should have bought it, breaking that down trend line right there. And then if you don't buy it, then you're out of the position and the stock marches higher and you're saying, oh, gee whiz. You know, gee whiz. I mean, you hit it you got the right stock at the right time and you didn't handle it properly. Happens all the time, guys.
Hey, Roy, I wanted to ask, how do you manage open positions? Do you use trailing stops? And if they get hit, how do you re-enter?
Hey, Alex, how are you?
Hey.
They're all mental stops. I mean, you know, it could be moving averages. It could be under prior support levels. It could be based on, you know, the percentage of capital the stock is. There's just so many different ways of handling, you know, the stops. I mean, there's almost like an infinite number, you know, it's also based on how the stock is trading. Like if the stock breaks out, and normally, you know, if it's going to a new high, a lot of these stocks have characteristics, like some never break the 21 day, and some go up relentlessly just using the 10 day. And so everything's different. Like, for example, this double verify. So this double verify broke out. That was the earnings report way back here. Went to a 52-week high, and look at where it held the 10 day. See, this stock never violated the 10 day on the whole point of the move until 5 days ago, going into earnings. And so, you know, in a situation like that, and we missed the stock. It was on our buy list and we missed it, but it never gave you even a little pullback to the 21 day. And so there's the characteristic. And when it broke, it broke. There's the abnormal action, Alex, right there that day where you had an outside day to the downside. If you're sitting there and watching it closely, and it's outside day to the downside and it's breaking the 10 day, that's really your exit point right there. Plus, it was going into earnings 2 days later. So that was abnormal action right there.
Yeah, actually, Roy, if I may, I think if you look at 3-4 days prior to that, there's some indication there as well, considering the earnings coming. So where it hit like 41.91 high, then it has a two good distribution day, and the close were actually at the bottom.
Yes.
And then it tried to recover, but the volume was low.
Yes.
So I think there was some breaking sign. And by the way, Fortinet had exactly the same signature as well, FTNT.
Yeah, it's hard to see it here. You can see it better on MarketSmith probably. Oops.
Yeah, exactly. If you look at the MarketSmith, FTNT had exactly the same signature.
There's the top, the reversal, and I'll show you like just kind of a tactic that I was looking at on this SMCI. And looking at this SMCI, the reason that we sold this SMCI, oops.
Hopefully before earning.
Yeah, we actually bought this stock right here. Do you guys see this chart, by the way? I changed the platform. It's AIQ. You see it? So we actually bought this stock right here at 123. It broke out. That was on an earnings report. So we bought it right here on this big earnings day. And the high was one. We bought it one. We didn't buy the open. See what? Oh, yeah, this is one. Yeah. So we didn't buy it because the market was concerning to us back at this time. We did not buy the open. This is exactly the one that I wanted to show you, Joseph. So it opened at 116. We didn't buy it. The low was only 114. We bought it at 123. And 123, we sold it. We sold it, I believe, right here or here. We sold it, I think, going through the Bollinger Band, these bands here. We sold it all right here. And then we bought it back at the 21 day right here. We bought it back. So, here, we made like 80% on the trade. And then we were out of the trade and MACD. And so we're watching this, MACD come in. We bought it back here, right in here, right here. And then what we were looking at, so we had so we're here back in here at like 220 or so. And we actually sold it. We sold it this day. Right there. And we were looking at this MACD turning down, peaking and turning down. And so we sold it, and we'd had this big move in it too. We wanted to protect the gain, and that's why we sold it. So, it's opening down SMCI. So it's down 32 after market. But it's just going to be down here to the 21-day. It's going to be interesting to see if it holds the 21-day again or if it goes to the 50. But that's what we were looking at. We were looking at some of these technical indicators. This day where the price phase turned down that day, that's when we sold right there. So these were just little clues. The SKSD. We got this had turned down, see where the move, see where it had turned down right here. And so that's why we sold it technically using these indicators that I mentioned to you before.
I'm sorry, what is SKSD?
SKSD, it's a derivation of George Lane's stochastics. It's a fast stochastic and a slow stochastics. You can Google it.
Okay, thank you. I will.
But it's quite useful with some of these major turning points.
Roy, just out of curiosity, why would you sell out of a true market leader completely? I mean, 80% is nice, but 800% is way better. Why would you not hold on to some shares and enjoy the ride?
Well, I mean, first of all, it's rare to get that true market leader, and we think that. Well, it's certainly in this case, it worked where we got in the stock, we sold it, got in the stock cheaper, and then we got out, and maybe we'll be able to get in the stock again cheaper. A lot of times back in 2020, you had that opportunity on Livongo and Datadog and Fastly and Zoom and DocuSign. You had an opportunity to not write them, not have them correct 20% on you. So it's just the nature of the market environment that you're in. But yeah, you never want to sell them if you could get like a Domino's pizza that went up for 14 straight years. But you just don't know. You can't find the next Domino pizza necessarily. So it's just how you want to handle it. It's how the market's trading as not PI, LI. And we thought that this was peaking right here, and that's why we sold it yesterday. And, going through the bands is extended, and, we didn't want to ride a pullback to the 21-day. And so we didn't. And, that's just try to look at all the tools that you have, and it's, there's a certain art to it, as well. But, really what I encourage you to do, and what we're trying to do, is you want to have, if you can get 10 true market leaders, get 10 stocks that double, and now you're going to be shaken out of many of these. I mean, we got kicked out of 5 stocks today, but we did have, the SMCI that was up 130% for us. And we're in NVIDIA that's up huge. And now Celsius is up huge. And the key is to have, 10% or 20% of your assets. And we're not going to go more than 10% ever for with clients' money, but often I put 25% in a position, in a personal position, personally. Often, because that's the way that you can have, that's the only way really to achieve triple digit returns, to have a year, a triple digit year. You're going to have to get the right stock and have a bunch of it. And, just like my friend Oliver Kale wrote this Tesla up in 2020 for a staggering return. And that was in 2020. And Oliver, you had one of these, just had one of these stocks where went up tenfold in a year, and he had his whole account there. But I won't do that. I won't do that anymore. I'm too old for that. But I'll put 20%, 25% in a position. And when the market environment's right, I'll have 8 of those and be 200% long. But that hasn't happened in a few years, since 2020.
Thanks for elaborating.
Yeah, this is interesting. What happened with that Tesla, how it went higher and higher. And you just look at it, you wonder, you think the move is over, and it's that last move where you get that last double. So it's not necessarily over. This SMCI might have another double in it. Date.
Yeah,
Zero.
the market cap's not that big on it, right? I don't know what the market cap is on it, but I don't think it's huge.
But man, yeah, this is another reason. Take a look at this. So this isn't using logarithmic. So take a look at this. I was talking to Wes, and see where it broke out here. See where the stock broke out here, where we have these trend lines drawn. But take a look at this on the daily. So when you're looking at something that goes parabolic, it just shows you the difference of looking at it on MarketSmith versus looking at it here. Let me go to the monthly. Yeah. That looks pretty extended, does it not?
Yeah, I would say so.
That's why we sold it. Like, gee whiz. And it could come in, this stock could come into 200 and still be, and didn't make its next leg up. But it's going to be interesting to see what happens with it. But it's certainly, it's certainly a leader, and the CEO has said, man, it's unprecedented demand that these guys have. So if that's the case, it may hold. It may hold the 21-day, or if it doesn't, the 50 days can probably, that shakeout of the 50 can probably be buyable. If it holds the 21-day and recovers off the 21-day, this is just a rocket ship, and it's going to 1,000. But so just watch, keep this on your radar. Guys, I think I'm gonna call it a night. I think I'm losing my voice.
Thank you, Roy, as always. Appreciate it.
Thank you guys for attending. I certainly wish you prosperity, health, success. I hope that the work that we put on the individual stock side points you in the right direction so that you can get some of these potential true market leaders. So just continue to work hard, screen for your stocks. This is definitely the time to do the due diligence. Remember, success is never final and failure is never fatal. Don't give up.
Thank you so much.
Have a good night, guys.
Thank you. Have a good evening. Bye.
Thank you. Good night. Bye.
Thank you, Roy.
Good night, guys.